Oh, it's me. Stream live.
See that screen.
Just let me know when we're ready, Brenna.
I think we're ready.
Okay, sounds good. Well, I'm going to call the meeting to order, and sorry that we weren't able to meet in person. I was actually really looking forward to bringing everyone in and being able to have a face-to-face meeting, but you know, Mother Nature always seems to be playing a role in things like this winter. So I was joking with Cole when he had emailed me about something else, and I said, well, maybe by July we could have a meeting. Maybe the snow might be gone by July, so we'll see. Okay, so first order of business is the consent agenda for January meeting minutes. If you all had an opportunity to review those, I'd like a motion to approve the minutes.
So moved.
Is there a second?
Second, Mike.
Okay, thanks, Mike. Is there any discussion? Okay, hearing none, instead of saying all in favor, say aye, I'll just say all opposed, say aye. Okay, motion carried. Operational update, bank account signers change and CD information. So at the bank, we currently had Brennan Quintus as chair of the NDPHIT board as a signer on the bank accounts, as well as I think just the bank accounts. And so we need to do an official change of that and include it in our board minutes, stating that that as chair of the NDPHIT board, that they'll include me on the bank accounts as one of the signers. And then is there any other updates, Brenna? I think that was it, correct?
Yeah, we just need a motion to remove Brennan and add Jenny.
Perfect. So if I could have a motion on that.
Moved.
Thanks, Brennan. Is there a second?
Second, Steve Hall.
Okay, thanks, Steve. Any discussion? All right. All those not in favor of the motion signify by saying aye. Motion carried. And then Brenna or Nora, I'm not sure who is going to do the CD information to just give us an update on what we've done there.
I can, since I have it in front of me, and I'm not sure if Nora does, but we work together. As you recall, you gave us permission to seek out some CDs for a little bit more investment and interest income. So we are using $1 million. The First Community Credit Union, we have a $250,000 CD for 11 months at 4.5%. And then with First International Bank, we have two different CDs, 500,000 at 6 months for 4% and 250 at 9 months for 4.05. So
Those are great rates.
Lauren, do you have anything more to add other than it was fairly easy?
Yep, it was really easy. And the only thing I would add is the reason we did the 250 at First Community was because that's what the insurance is up to. And so we didn't want to go over anything that's insured, whereas First International has all our deposits. And so they do it. They would only do the excess at First Community if we moved our deposits there. And we didn't really want to do that since we just moved them. But yeah, so that's the reason why we only did 250 at First Community, because that amount stays insured then.
Yep.
Perfect. And that is a great rate on all of those, particularly for that short of a term for CDs, being able to get 4% or higher. That's awesome. So thank you both for getting that done on behalf of NDPHIT. Next up is our COBRA vendor change recommendation. I know as a board last time we had discussed our current COBRA administrator, Wex, and that we've had some struggles with the administration piece. As far as ease of use, and I think having issues with customer service and all of those kinds of things. And so we had instructed Brown and Brown to take a look at some options for our Cobra vendors. And so I'm going to turn this over to Stephanie. I think you are going to be doing kind of an overview after you put out an RFP for some potential vendors, and I don't want to taint anyone's decision on who we go with, but I was amazed at the differential in fees when you're looking at similar services. I could see maybe a $10,000 to $15,000 difference, but it's like tens of thousands of dollars different. I was a little bit surprised to see that. But Stephanie, I'm going to let you take the lead and go through what you found.
Would you like me to share my screen?
Yes, that'd be great.
Okay. All right, can you see my screen?
Yes.
Great.
Is there a way you could expand, take it or put it into, take it out of preview mode? That would help.
I'm trying. Let's go.
Stand.
Slides.
Up there at the bottom. Yeah.
Is it this one?
Yep.
Hold please. That moved it to a new screen. So let me stop sharing and move it to a new screen. All right. Does that work better?
Yes.
Okay. That screen is clear over here. So if you're looking at the back of my head, I apologize. But we'll go ahead and get started. As Jenny mentioned, we were asked to do an RFP to find a Cobra vendor specifically to meet the needs of the trust. The primary goals that we had sought to achieve were to find a vendor that worked with trusts and had trust experience, one that would actually contract directly with NDPHIT as well as the member groups to make sure that they still were responsible for their portion of the Cobra delivery product. And then to also make sure that we had a vendor who could accommodate billing because we're finding that there's some discrepancies there between the invoicing process the fees go to the member groups versus what NDPHIT is able to collect and remit back to the carrier. So we were looking for multiple solutions there. And ultimately, the overall goal would be to bring a better customer service experience to everyone at the table, especially the member groups, because right now we know the feedback is not good. So with that said, we're going to be looking at the original objective, the market response, Cobra finalists. We'll address any questions that you have. And then in the appendix, in the materials that Brenna sent, she sent over the full RFP that we went through. So you can see all of the questions that we asked the vendors, all of the responses that they provided, as well as the additional follow-up that was done. And I must also mention that the Brown & Brown team that worked on this behind the scenes did a very thorough job, and what you're seeing here is the result of those efforts. So we'll talk about the market objective and response first. So NDPHIT is a plan sponsor. You're responsible for Cobra, but currently with WEX, there's no direct contract, and so there's no direct control. There's also no direct account management team. So anytime a member group is being onboarded with WEX, they have no idea that they're part of NDPHIT. Their billing department knows that they're part of NDPHIT, but customer service has no idea. They just see the individual member group. And that's really causing a lot of disparity in the implementation process, in the delivery of the Cobra product and the system. So we're trying to improve that. NDPHIT does pay the basic Cobra admin fee. The member groups are responsible for any additional fees, such as enrollment packets or ARPA notices and things like that. Right now, as I mentioned, there's no direct customer service support, and we've had repeated complaints, so we're looking for a solution. We want one that will contract directly with a parent-child relationship. So the owner of this product would be NDPHIT. You would be responsible for the Cobra vendor relationship, and we would have more direct control over the implementation with each member group as well. We actually went to the market with multiple vendors. WEX is the current administrator, but we don't have a contract, so we're going to be focusing primarily on those that we received responses from. Ameriflex did not quote. Optum, we pulled back our RFP from them because they outsourced to WEX, and they're not set up to do what we need them to do because they're using WEX specifically. And then we received a decline to quote from ThrivePass because they felt that there was no certainty in who would be coming on to the system. And they felt like they couldn't quote a specific rate for that. So right now with WEX, we're estimating your annual fees that are being paid by NDPHIT at about $45,000 because we're going to be adding more groups as we go through 10-1. So that's just a rough estimate. So we have 3 finalists. The 3 finalists are iSolved, Voya, and EBC Flex. Now, we ruled out EBC Flex immediately because they are unable to come to the table with anything more than what WEX can provide us. And so after we went through the RFP process and witnessed their presentation, we ruled them out immediately. So the 2 contenders we have at the table are iSolved and Voya. Now, iSolved has no experience with trusts. And that was a big concern for us because of the complexity of where we're at with NDPHIT, with the 2 renewal cycles, with multiple onboarding, with changes in groups. They are the lowest cost option. And by lowest, I mean significantly lower even than WEX. Our concern is that they don't truly understand the complexities of trusts and what they're taking on. And I don't mean to throw out an old adage, but you know, that saying, you get what you pay for. We're concerned that they're biting off more than they can chew with this trust. That being said, we did actually, Angie did reach out and speak to one of their referrals. And so there is a light at the end of the tunnel, and we'll speak to that in just a moment. Voya hit all the marks. Voya has experience with trusts, multiple years of experience and with multiple trusts. They also have the ability to provide all the services that we requested, as did iSolved. They mentioned that as well. They are the most expensive, but of the 3 who quoted, they are also the most qualified. In our finals presentations, they brought all the right players to the table. They answered all the technical questions. They did a deep dive with us for like an hour and a half. And iSolved, we really didn't get that kind of a deep dive with them. And that's, again, why we're concerned that they may not fully understand what they're biting off. This is where the rubber hits the road with the fees. And I'm just going to kind of walk through this with you to show you all of the areas that we looked at in terms of trying to vet this vendor or these vendors. So we looked, first of all, at the member groups because there is a fee per member group from Voya. So that's critical to their pricing. Enrollment is based off of the current enrollment at the time we send out the RFP, and that's going to fluctuate, right? So fees based on enrollment will fluctuate. And then the COBRA continuance. That's also part of the COBRA takeover fee that is mentioned there in the red. So on a per employee per month basis, they each have a fee, and iSolved is 45 cents and Voya's is 50 cents. And for Voya, that means that you would have to have about 200 employees per member group in order to be billed that 50 cents. Otherwise, you're going to be subject to a $100 minimum monthly fee. And it's that $100 minimum monthly fee that causes Voya to be the most expensive vendor. There is an annual fee of $500 from iSolved. And because they're looking at NDPHIT as a single unit and not looking at the individual member groups that they have to support, they're just looking at NDPHIT, that $500 is just that one-time fee. And you're not going to get hit with that individual member fee of $100 per month. All of these other things, the notices, the continuing billing, the expiration notice, the early termination notice, all of those things are included in their billing. And those are all things that would have to be done if you're doing it in-house. Those are all the notices that you would have to be sending out and managing. And they're basically, that's the basic corporate administration. Qualified beneficiary takeover is where they're bringing groups over from WEX, and that's the individual fee of $25. So that's also something to consider with the Voya fee. Now, that is a fee because the way we're structured currently, that is a fee that could be passed on to the individual member groups, or NDPHIT could choose to absorb that. We did not include that fee in our estimated pricing at this point, but that would be based off of the COBRA continuance of 5 or 31, depending on the renewal groups. And then, of course, general rights notices, special notices, those are all included One thing to note with iSolved open enrollment information, they will send out an open enrollment packet to all current COBRA participants, but they do charge an individual fee of $12 per packet. That would be billed to the individual member groups. So we wanted to call that out as a fee that would be billed to those member groups. That isn't any different than what we have currently with WEX, where they are contracted directly with the member groups, and the only fee that NDPHIT is supporting is that basic COBRA admin. And then, of course, the 2% admin fee is billed to the COBRA participant when they elect COBRA. And that's standard across the board. So at the end of the day, when we start to look at the monthly costs, this is where you start to see that huge discrepancy between the rates, between what Jenny mentioned earlier. It's about $45,000 annually with WEX as an estimate. iSolved, and we checked this and double checked this with iSolved, they're basing it on the per employee per month fee of 45 cents. And that is bringing us to about an $18,000 fee, assuming every single member group participates with this. Under the Voya, because they're subject to that $100 fee, and you'd have to have 200 participants to get to the 50-cent PEPM, we based it off of, there are 45 groups in the renewal 1-1 group, and none of them have 200 participants. So that's where we're coming up with that fee. And then under our 10-1 effective dates, only one group exceeds 200 employees. And so that's why that's a little different rate. We calculated it out with that group, and there are 50-cent PEPM fee, and then all the other groups would be subject to that $100 minimum. The way it's set up currently and the way it would be set up with either of these vendors, each member group is its own member group. There is a specific implementation process that has to happen with each member group. And when we talked to Voya and tried to negotiate that $100 down, they basically came off of, I think, an original fee of $150. So that $100 is a negotiated fee, and they refuse to come down any further than that. And part of that is because they have experience with trusts. They know the level of detail that has to go into the original implementation process and the setup, and that each one is customized and different, and that they'll also be supporting non-NDPHIT products because it's COBRA. And if you have dental and vision with Blue Cross Blue Shield, it's COBRA. You have to offer them COBRA. And that doesn't change that fee. So when we look at the final estimate over here to the right of $106,000, that's based off of current WEX participation. So I want to caveat that the $133,848 from Voya assumes that every single group would participate under Voya, that it would just be, you know, we're going to move everyone over to Voya, and this is going to be the COBRA process. And so we gave you worst case scenario. And then we looked at who is actually participating with WEX and gave that estimate, assuming that everyone who is with WEX currently would move to Voya or in the future. And the same thing with the estimate for iSolved. It assumes that everyone who currently has an employee would be moving to iSolved. So that $18,000 could be potentially less than that. We just didn't run the estimate for that because it's already such a great rate. Are there any questions? I know I covered a lot of information on those fees.
Stephanie, I do have a question in regards to when you talk about the individual member groups being part of Voya or iSolve, but if right currently WEX is contracted with each individual member group, but if I'm understanding this correctly, we're looking to actually have an agreement between NDPHIT and XYZ company.
Yes.
So are we then allowing our current NDPHIT members still the option on whether they go with who we are picking as our preferred provider?
That is up to you to decide. Either vendor can go either way. So we asked them to quote it as if that choice was still left to the member groups. And we asked them to quote it as if they were taking on all of those employees and all of those member groups. So they can go either way. And that will be a decision for NDPHIT to decide, is it all or do we keep it the way that it is?
Okay. And if it's all, that 106,000 then would not be the number because that's just who's currently with WEX. The 133,000 is including every entity, whether they're enrolled in WEX or not, correct?
Correct.
Okay,
Correct.
Just wanted to make sure I understood that correctly.
Yep. You did, and that's a great question.
Anyone else have questions so far in regards to,
Yep, this is Cole. So just a quick question here. I understand if I look at Voya on the far right, the 6,654, that's the monthly charge time 12 equals 79,848. And that 6654 is everything listed above it, correct? Trying to get a handle on how the 6654 came together for a monthly fee. I'm assuming it's all the itemized things listed above it.
No, it's basically the same thing as basically saying that there are 65 groups at $100 and then one group at 50 cents per employee per month. Does that make sense?
Also, it doesn't include that takeover fee.
No, it doesn't include a takeover fee.
Yeah, I guess that's what I'm trying to make sure that how the 6654 is calculated, because I get that's the number they have as a monthly fee, but I ran the numbers on my own calculator trying to figure out how I came up. I came up with a different number. So I'm just trying to make sure how that came up.
You've got one group in there that's not going to be based on straight 100. It's not going to be based on straight 100. And it's possible that is a typo, and I can double check those figures. I'd be happy to double check those figures. I'd have to just go back for the one group that has over 200 employees. It's going to be 50 cents times whatever those 200 employees. But I can see what you're saying, that it shouldn't be 6654 if we've got, it's so 65 groups at 100 minus 6654 would give you $154. And so that's how you back into the 50 cents per employee per month. That is the figure to come up with the 6654. Does that make sense?
so
one
when you
group-
calculate that, Stephanie, you're looking at that one group having, if the numbers are accurate, that group would have 308 employees.
Yeah, I don't do math in my
Okay,
head, so
that's okay.
without a calculator, I cannot confirm or deny.
Right.
So basically those two fees, the 50 cents per employee per month is only charged if the $100 minimum is met. So you have to have at least 200 employees to get to $100.
Which is
Does that make sense?
nobody but one group.
Yeah, there's only one group
That
There's only one group.
falls.
Mhm,
So really,
that
it's
exceeds
$100 per group per month,
mhm.
essentially, is an easy way to look at it. Aside from
Yep,
that one.
and any new group that comes on, if they're below 200 lives, it's going to be a $100 fee to NDPHIT per month.
And is the $25 takeover fee, is that per month until they're done using Cobra?
believe-
Or is that just a one-time fee to transfer them over?
That's a one-time fee to transfer them over.
112 times 25. That's $2,800. So we're really comparing the 45,000 that we currently pay WEX to potentially 106 if we allow.
Is it passed on in their premium somehow?
So WEX is currently in the underwriting as a fixed fee, that's that, and if we, and assuming you have just the existing groups go over, that's what that 106 number is, but if you offer it to everybody, I mean, if everybody comes over, then it's the 133.
Right.
So that's, so our, and I know Stephanie will get this, but our suggestion is probably because of the great divide, if you would, of cost between these two finalists, that it's better, it's probably appropriate to have a couple of board members sit in on just like a finalist presentation, and where we kind of highlight the important questions. After that, then it can be decided by, the 2 or 3 people that would be interested in doing that, so that, after their assessment, in collaboration with the questions that are asked, a recommendation could be offered up, and then they could move forward with whatever that recommendation is. It's just because it is a large number, and you have to decide how much more value is there to pay that extra, $80,000 to $100,000 a year, based on the experience or the processes that one vendor has over another. So.
Stephanie, I understand that iSolve doesn't have or hasn't so far had experience with trusts, but I know that they have multiple divisions. They're working with a company that had multiple divisions. How
Yes.
does that differ from having a parent-child compared to what they're dealing with the multiple divisions scenario?
So in that scenario where you've got a parent-child relationship and you've got one employer and you've got these 800 groups, they've got total control, right? Because it's their company. They have everything, they own everything. And so they're still going to have to rely on their divisions to satisfy the COVID requirements. Our biggest concern with iSolved isn't necessarily the onboarding, because the referral was amazing. Our concern is there's no history. They came on January 1, 2023. So we don't know what the EDI file feed process is going to be like. We don't know how the billing really plays out. They've only got the onboarding behind them and they don't have any full experience. So they came through with flying colors in an onboarding process. And we were really impressed with that, really impressed with that. Angie had the opportunity to speak directly with the member group that went through that process. They don't like brokers to talk to, potential clients. So Seek took on the role of making sure that they vetted the referrals. And in that scenario, we were really surprised at how things went, because they did have 800 divisions. They did have divisions that came on and made changes midstream, and the comments were that iSolved was flexible. In fact, if you'll allow me to, I will jump ahead a few slides and just talk about the referrals. So Decisely was the name of the company. They're not a trust, but that large employer. They are set up with a parent-child relationship. And in the comments, and Angie can probably speak to this better than I am, not to throw you under the bus here, Angie, or put you on the spot. But basically, he came forward to Angie and said right off the bat, it was not necessarily a smooth process. And they implemented this large employer group within a month. And he was part of the reason why it wasn't a smooth process, because he didn't have the support he needed on his end to get them the information timely. But even though he was behind, they didn't stop the process or hold things up. They got his information and jumped right on it and didn't say anything to him like, oh, well, you're behind in the queue. And this was fourth quarter. This was in December, where it's the busiest time of year for all vendors. And so again, we were really impressed with the feedback and his honesty and his comments about iSolved. But again, going back to, that's just one piece of the puzzle. And we have, multiple things downstream that also have to be taken into consideration that iSolved just doesn't have experience with yet, or at least not with this 800 life vendor. And that was the referral they gave us. So does that help answer that question?
Yes. Yep.
Question, Stephanie.
Oh, go ahead.
So, Stephanie, with regard to like the inexperienced, were they able to show, even though they've not had experience, were they able to show how they could handle those additional things that would happen down the road?
They answered all of our RFP questions. So from that perspective on paper, they answered everything in terms of, yes, we can handle this billing. Yes, we can remit the premium payment back to NDPHIT if we need to. Yes, we can set up EDI file feeds. They said, yes, that they can handle COBRA vendors that are not under the, or not COBRA vendors. They can handle carriers and administer their COBRA that are not NDPHITs for each of these individual groups. They said, yes, that they could handle the customization at the member group level. They said yes to all of those things. So on paper,
the 800 division employer, with the onboarding and the kind of the early results, was there anything discussed that differentiated or was different from the way iSolved explained that would happen with that early process and how it happened, in the actual onboarding and early process? And where I'm getting with that is, are we able to point to inconsistencies early on with what we know has happened, and then kind of look down the road and say, okay, well, early on they said this is how it's going to be, and it ended up not being differently. We could expect then down the road that there would be differences, but if they've nailed it early on, I mean, maybe there's a little bit more credibility there.
So we can say definitively that they nailed this onboarding implementation, but we can't say definitively that they've nailed the billing, the EDI file feed process, ongoing administration. And we can't say definitively that they've got experience with multiple renewal periods either, or with how, the trust will be operating in terms of an onboarding and renewal cycle, twice a year.
Are there things in the process that you guys point to saying like they're non-negotiable? Like we got to have the file feed, or we've got to have, whatever it might be. I'm not familiar with how Cobra would work with how you guys would handle it. So are there things like that where we can point to and say that there's no negotiation like that? That's got to happen, and it's got to happen well. And are we able to look at what iSolved has done, or is able to show and say, okay, they can do it based on what we would expect?
So EDI file feeds are pretty standard in the industry. And so, being able to manage an EDI file feed process, everyone says they can do it. But it's when you get into the actual administration of the process, like for example, I know without a doubt, whether we go with iSolved or Voya, we're going to have a single point of contact to be able to talk to them and say, hey, this is what's wrong with the file feed. This is where we're not connecting. And I have 100% confidence in the EB Tech team that they're going to be able to work through some of these issues. But there's a unique file structure at Blue Cross Blue Shield of North Dakota where some groups have 2 group numbers because it's based on single and family. And so each group gets a group number that says, 10559 single, 10559 family. Right now we're fighting with WEX because they can't accommodate those 2 group numbers because the file feed from EB Tech is, we've got one group number, we're sending single and family in a tier structure over here. It's the same group number, just single and family over here. But Blue Cross Blue Shield requires it as 2 group numbers. And I know I'm getting the weeds on this and I apologize, but that's just kind of an example. And so we're struggling with WEX to get them to all come to the table, to get everyone on their team to recognize that some groups will have 1, some groups will have 2. How do we find a solution? And so those are the types of things that we're working with on an individual member group because we don't have a single parent person to work with, and it's difficult to get that resolved. So it's those types of issues that come up through the process that, this vendor does it completely differently than this vendor, and we have to trust that their EDI team is going to be able to accommodate and work with all of those scenarios. And we don't know what those scenarios are going to be until we get into the weeds. Does that help?
But yeah. So iSolved though has showed that they can accommodate what you guys would want with, as an example, that feed.
They have indicated that they can handle EDI feeds, but until we actually get into the weeds, we have no proof, I guess. We have to trust that they say that they can do what they do. And that it's that way with Voya as well. It will be that way with any Cobra vendor. They say they can handle EDI feeds. Yes.
And just some context around that, I think what Stephanie's referring to is that the question is within trust environment versus they do this all day long with employers because they have hundreds, if not thousands of employers, that being iSolved, that they do this currently. It's not, so their capabilities in meeting functionality, they could check the boxes and do it. It's just the context or the environment of a trust.
And the complexity of the trust, and maybe I'm just looking at it too simple here, but in my mind, it would just be, well, we've got multiple groups that do things differently at every single group level. Is that correct?
Yeah.
Is that why it's complicated at the trust situation?
Yeah,
okay.
Exactly right. It's just different within the trust environment because of the kind of what Seppi alluded to is the complexity that Blue Cross has their kind of set up. And so, they need to be able to have the performance that they can accomplish that within that environment and understand those complexities. And if they do, and there's a clear delineation that, yes, we understand it and we've done this and we know how to do it. And of course, as I mentioned, they do it for hundreds, if not thousands of employers every day already. It's just can they do it within that structure? That's really what it gets down to. But also to Stephanie's point, we'd be asking Boya to do the same accommodation.
The other thing I could do, if iSolved is the direction that the trust wants to go, we can ask for performance guarantees from both Voya and iSolved and say, hey, you have to meet this performance standard. And if it's not met, then this is the consequence.
Put your fees at risk. And that's it's not uncommon for us to put performance guarantees with vendors to ensure that they meet the standard and the time frame and the structure. So I think that's a fair ask, is to put a performance guarantee in place.
Mm-hmm.
Do you think if you
so
would?
Another question from, oh, sorry, Jenny, go ahead.
Nope, go ahead, Brennan.
From a timing standpoint, so I like the idea of maybe diving on a little bit further from a board perspective, because there is that's a huge difference. And I think we got to make sure we understand what's going on here. But from a timing standpoint, is there anything out there that we need a decision made, before a certain date or anything like that? Because I'd hate to drag our feet if we've got an issue out there that we've got to make sure is corrected by a certain time.
So my biggest concern is timeline of the renewal that we're talking about today, because as soon as the renewal decisions are made, we're starting to put together all the paperwork and starting to put together all of the COBRA, all of the decisions, including COBRA. So we would be announcing, or we would hope to be able to announce at the time that we're doing these calls to talk about the medical, dental, vision renewals, to also be able to say, and, we've also heard your feedback on WEX. NDPHIT has made a decision about the COBRA vendor. This is the direction they're taking, and here's what you need to know. If we have to do this call another time and do COBRA completely separately, yes, we can accommodate that. And in that regard, if we completely remove it from the renewal process, then we would want, if it's a 10/1 effective date, I would love to have 90 days just to have that cushion. Could we do it in less than 90? iSolved did it with that 800 division group in 30. I don't want to put anyone in that position because that's a nightmare. So if we could do it in less, with more time, that would be preferred.
Well, and that was going to be my comment as far as a concern. We don't have a great system in place right now, and I would hate to, if either of the events, we want to make sure this is going to be obviously successful. We want to make sure that our administrators, our folks who are handling this COBRA administration duties, is able to work with an organization that we feel confident with and the like. If you look at doing performance parameters requirements, it would be interesting to see if we would get pushback from either organization. And I think that would speak volumes on whether that, if that would be an issue for either of them. I think that would raise a red flag, at least in my mind. I don't know how anybody else feels about that, but I do think that may be the next step, is finding out how both of these entities feel about meeting those performance measures. And then what does the board think about having a maybe like a subcommittee to meet with Stephanie and the two groups to kind of do a final walkthrough in regards to that, and then be able to bring that back to the board? Again, timing is everything, but I also feel it's important for us to do our due diligence in this as well. So I'd be interested in your guys' feedback on that.
This is Cole, and I was listening just to get a better handle here. So if you can go back to that spreadsheet for the fees again. So my question is to the board, and being relatively a year now on this board and trying to learn a little bit here. You said these fees have to be passed on to North Dakota FIT. So there's $133,000 that potentially NDPHIT would have to figure out how to pay for. And then I look over on the other side of iSolved, and the total cost is, I'm just going to use the 20,000 just because it seems reasonable to talk about. That 20 grand, and it sounds like customer service is decent. It sounds like all the other components are good. Other than that, they don't have trust experience, which hopefully they can get to that level. But we can absorb the 20 grand. How do we absorb the 133?
Yeah, it'd be the cost difference between 133 and our current 45, because we already paid 45 already to WEX. So that it's that delta between the 133 and the 45, which is, if you look right below, if you do add Voya, based on the current renewal, it's a 0.2% increase above the current renewal that we're going to present here at the end. So that's how it has to be funded. If you go with the Voya option, whereas if you go with the other option, it's essentially a windfall savings between the 45 and the 20 back to the trust.
You know,
And
the
that,
other question,
that 0.2 is calculated based on the 133,000 versus the 106.
Yep.
So that is the worst case scenario.
couple of ideas or a couple of questions. So one of the decisions we would make is everyone in? NDPHIT just says this is who our COBRA administrator is, and that's who we work with. Or we say, okay, you guys can choose. I'm just thinking from a support standpoint. Obviously, I would assume there would be more efficiencies with NDPHIT just saying this is our administrator moving forward. And then the second kind of question that I would have is, I know both of these organizations handle COBRA. What is do you know what their client numbers are? Like, Voya I know is huge. But, adding another 2,000 individuals or member groups coming on isn't a small feat. And so making sure staffing levels are appropriate to be able to handle this large of a group. Is there any concern from that standpoint?
Go ahead, Stephanie.
I was going to say, we're not concerned with staffing levels on that point. iSolved and Voya both committed to a dedicated team at the beginning. That was part of our RFP process, is to say, you have to have this at the front. You have to have a dedicated team to support not just Seek as the trust administrator, but you also have to support the member group onboarding process. And each one of them came to the table saying there would be a dedicated team, whether that's 2 or 3 individual members. That team would work directly with NDPHIT. Each of the member groups would be part of the onboarding process. And that was committed to at the beginning. Great question.
Okay, any other comments or questions in regards to this?
I like the idea of asking the question about the performance guarantee. How quickly we can do that. I guess we'd have, as a board member, I'd have to take your lead on what to do with that. But I think Cole's question too, that Randy answered, I was wondering about the box down below there. That's how we would recover that fee, by adding that on there. So that's why I was also wondering about how that fits into our finances.
Yeah.
So maybe,
yes,
go ahead.
Sorry, go ahead. To answer your question about the performance guarantees, both of the finalist vendors have been chomping at the bit to hear feedback. We could reach out to them this afternoon after the board meeting, and begin the discussions for performance guarantees, and at least get an initial feeling, even though we don't have the performance guarantees identified and specifically what those requirements will be by this afternoon. We can at least say, are you willing to put your fees at risk for performance guarantees? And we could hopefully get that response by tomorrow, hopefully, if not this afternoon.
I think that would be helpful, Stephanie, because again, I think that gives us a pulse on what their responses are, if they're both still eager and want to move forward. And yes, we will do that. I think then I think we have some discussions to make, because it's hard. What's really hard for me when I'm looking at this spreadsheet is I know there's some inexperience from iSolved, but when I'm looking at over $100,000 difference in service fees to be providing COBRA administration, I'm just thinking, is Voya's value that much higher to spend that much more of our NDPHIT member dollars to provide this administration? I also don't want it to go up in flames by taking on an organization that isn't able to provide us the services that we need. And and just to make sure too, the fees that they're guaranteeing, when you say the 2 years below and the 3 years below, they're actually asking for, iSolve is asking for a 2-year commitment and Voya is asking for a 3-year commitment. Is that correct?
Yes, but within the contract terms, there's usually a termination provision that says that you can terminate, within X amount of notification. So that could be also vetted to just make sure that, if you have termination reasons for cause, that you could terminate within, 30 or 60 days, probably
Okay.
60 days to give them enough time to account for that loss, but.
So I guess my question is then for this board, for what reasons would we, if their performance guarantees are in place with iSolve, what would be the rationale of which we would not look at them? Because to me, that would eliminate the concerns. They're substantially cheaper. So if we can get the performance guarantees applied to iSolve, why would we not approve that?
Right, and I agree, Steve. I was just gonna say the same thing. I think we could best seek with the authority to enter into an agreement with iSolve if we have certain performance guarantees in place. And because from my perspective, that would be, I don't see any issue with the inexperience if they're willing to guarantee, yeah, we're gonna do certain things.
That's my point too. We can make that motion today, I would think, unless there's a reason not to.
I'll second it, Steve.
Okay, we have a motion and a second. Is there any further discussion? And just to clarify on the motion is for Brown and Brown to move forward in discussing the parameter or measurements, the performance measurements guarantees with both entities. And if we have, I know this is a really long motion, but just want to explain what we're doing. And if those come back in a positive light, we are actually seek the authority to move forward with an agreement. Is that correct?
That would be correct for my motion.
Okay. So any further discussion or questions?
Just a comment. It sounds like it can't get any worse than what we're dealing with WEX. So that's my comment.
Good point.
Appreciate that, Mike. Yeah. Okay, so with there being no further discussion, all of those not in support of the motion signify by saying aye. Okay, motion carried. So Steph, if you can work with the Cobra groups to get some answers for us on performance measures. And if you could, just as for informational purposes, I think it would be important to just email the board with your findings. So we're all aware of what you found out. That would be great.
Absolutely. Yes, absolutely. Would you also like to see the performance guarantees?
Please. And maybe I think that would be important. Board, do you want to see those before they go out to the organizations? Or are you comfortable just moving forward with Brown and Brown and Seek administering what we want as those performance guarantees?
From my seat, I don't need to see them. I would just say that I'd ask that they be consistent between obviously the two companies. So we're not asking, iSolve to do something that we're not asking Voya to do, but just a consistent, here's what we need.
Yes, they would be. Absolutely.
All right, great. Is there anything else in the presentation, Stephanie, that you had that you wanted to go through?
No, really, we covered everything without even having to go through the slides. That would be it. Let me just double check and make sure. We've covered everything.
Okay, so I think we've got marching orders on how we're going to move forward with our Cobra administration. Thank you for putting that together, and thank you for reaching out and being able to bring those RFPs to the board, because I know that it's a lot of work.
Oh, no problem. No problem. I'm trying to stop sharing my screen, but it won't give me the. You're welcome, we should say. And again, I have to give credit to the great team and the great support that we got from Seek in order to put this all together. So
excellent. Well, it's good to hear that you guys, both Brenna and Stephanie, you guys made a good team in getting that done. So thank you for moving forward with that. Mental health parity update. Randy, I think you were going to give us an update on where we're at with that.
Yeah, well, on the mental health parity, essentially, we have got, working with Blue Cross, it goes back to our discussion in the last meeting where we have to be compliant to the mental health parity laws, which means we have to do an update with our plan design with a few groups. So we worked that through with Blue Cross, and we're rolling that process out for those updates. I want to say, what is it, Stephanie, 3 or 4 groups that needed that requirement update? Now, I mean,
There's actually
in January,
16 groups.
Yeah, 16, but that's the all groups, right?
All groups, 16 groups. And we were going to, based on the board's recommendation from the last meeting, they wanted them all to be done at the same time.
Yeah, so we combined it. So there's 3, I think, from the January, and then the others are coming from the October pool.
Correct.
But that's all being done at the same time, and we got Blue Cross to finally make the adjustments we need for parity in the plan design structure for the actuarial values. That was the other thing that we had worked out with them. So anyway, that's just an update. Stephanie, I don't know if you want to make any other comment about what we've done through that.
Sure. So one of the other items, it's not just the plan design that's changing. They mentioned this to us just several weeks ago, that they're actually also changing the network. So that will also be part of the process, is that they'll be moving to the PPO network. Per Blue Cross Blue Shield, they have indicated that the current network and the PPO network share the same providers and the same fee schedule, because my concern is primarily, do we get different discounts if you move it to a different network? Because they didn't bother to vet that process with us. They just said, this is what we're doing. So I started to ask them questions about, well, is there disruption for the membership? So I received disruption reports last night. I'll be reviewing them today to see if there are any members that are actually impacted by moving from the traditional to the PPO. The primary impact for NDPHIT financially is that because it's a PPO, they offer a different pricing structure for out-of-state Blue Card fees. And so they anticipate that you'll see savings if services are received out of state on those Blue Card fees and on those network discounts that you'll be getting out of state. So we asked them to let us know, well, how many members are we really talking about of these 16 groups that are utilizing services out of state? My guess is that it's not a significant savings that will be seen by NDPHIT, but until we have the numbers, we don't know.
And none of these members are losing any benefit per se, particularly with switching over to a PPO.
Correct.
Okay.
They are getting a different benefit design to meet mental health parity. And a copy of that, I believe, was provided by Brenna.
Okay.
Yes.
Yeah, I apologize. It went out late. We had to discuss the network with Blue Cross yesterday. And so the memo didn't get completed until that conversation was had.
Okay. Okay. Anything else in regards to that? All right, I want to give just a real quick update on the Stutzman County. They had initially put in a letter to be removed from, or to rescind their membership, if you will. Not rescind, it should say that they were requesting to be removed from the NDPHIT plan as of January of 2024. And then after further discussion with them, because they wanted to have a quote to determine if they should stay or not stay, and so we did share with them what our policy was from our board in how we handle those processes. And after discussion with their commission, and I know Randy actually met with them as well to discuss what it all meant and why their fees or their premiums were higher. And I think it overall was a very positive meeting. Their commission decided to rescind their letter to be removed from the NDPHIT program. And so they are going to continue to be in our trust. So just wanted to give everyone an update on that. Round 6 sales cycle. Randy, if you want to update us on that.
Yep, we have, there's a total of 29 who have requested interest to join in October of the groups. 1 is from Sanford Direct, 4 is from NDPHIT, and the remainder with Blue Cross currently. And so we are just waiting to get the final loss ratio history and large claimant information from all those, from Sanford and Blue Cross, so that we can put them into the underwriting model and determine which ones meet the criteria for consideration. And as soon as we get that, hopefully it comes this week, because we're past the deadline we actually gave the carriers, but we're working with them to get that to us. So hopefully our plan is to get, and John is spearheading this process, but we plan to get in front of those groups all within the next 10 days to finalize those that can be considered an offer. And we're going to use the criteria that was approved by the board a few board meetings ago, who could be eligible and who would not. So any questions on those, on that process?
And Randy, those 29 entities that are asking to be part of the group, are those all for October 1 renewals, or is it?
Those are October 1. Mm-hmm.
Okay.
Yeah. So.
Okay, any questions on that? It's encouraging to hear that we're definitely gaining, I think, from political subdivisions, knowing that there's also another 29 entities that are looking at us saying, yeah, we're interested in maybe making some changes. So it's just making our trust that much stronger. Hopefully they're good risk pool, and we can bring them on. So MetLife Tech Credit, there's great news to be able to share with the board. Yeah, excited about this one. Randy, go ahead.
Yep. So can you, let's see, hopefully I can share that screen, maybe we'll get there.
Yeah, you're shared. It's just in the preview mode.
Oh.
There you go.
So can you see the large screen?
Not yet.
Oh, how does it?
Yep, now it's in display mode.
How do I change that from display? Oh, it's display settings. Let's see. I have to go duplicate slideshow, I think. Did that change?
There you go. You've got it.
Okay. I don't know technology, but I got that one right. So here's the calculation for the tech credit. That was just to give some background on this again. We approached MetLife about using those that enroll in voluntary plans. If they could give us a 3% technology credit and actually it's a Brown and Brown fee because of the process of the contract that we have with them. But we, as part of that, it's the idea that we give it back it's in the support and behalf of NDPHIT as a trust. So so this is the calculation for last year, 44,450. I think this last quarter you can see it's lower than the prior months, and so I asked MetLife to give us kind of the analysis as to why it's kind of adjusted by month the way they did it, but I didn't have that as of today, but we will be getting that information. We estimated, if you remember, somewhere between 40 and 50,000 when we originally proposed this based on the volume. So this came out to be 44,450. And we'll be working with, it just got posted this month. So we will be working with Brenna to determine the best way for accounting purposes to get that money back to the trust. It might be an offset to the fees that are paid for tech services, on the monthly invoice. But we'll figure that out. But it's important to know that we followed through, we got this passed, and we got the credit back that's coming back to the trust. Any questions on that?
And again, Randy, can you share how that fee is calculated?
Yeah, so you take all the voluntary benefits that are offered to all the trust members, and that would be dental, vision, life, cancer, critical illness, accident policies, and hospital indemnity. Those are the main product lines, and legal. They have a legal product too that's offered to the trust members. So the employees themselves can enroll in those products. Think about it as like an Aflac product. If the employees have Aflac, and instead of offering Aflac at the employer level, they offer MetLife, then whatever the premium generated on the voluntary portion paid by the employees goes back to the trust at that 3%. Does that make sense?
Yes, thank you. Does anybody have any questions in regards to the tech credit? This is great news. I mean, being able to bring back a savings of nearly $45,000 to the trust that's great.
Yep. And do you want me to just continue on the next?
Yeah,
item?
if you would, Randy, that would be great.
Okay. So the next one is this is also with MetLife. We asked them to see if they could come up with some methodology that supports our wellness initiatives and our population health initiatives, and create kind of a better product portfolio that incentivizes employees to participate. Not only would they gain that 3% of whatever those employees pay, as I mentioned on the tech credit, but also they could benefit from a direct reimbursement for doing preventative services. So MetLife has an entire package of supporting health and wellness initiatives by employers. And they have an entire communication model that I'll show you just some parameters to that would be customized for NDPHIT in this effort to support whatever the initiatives are by the trust. But also they've offered to provide this wellness screening benefit of $150 per person on the trust if you're enrolled in an accident policy. So all those things you see on the left are available for that $150 annual credit. So if you have a dental exam, a preventative exam, an eye exam, you can see it's vast. It's a very vast list that anybody could use or go to, and then they get the $150. And again, what's unique about it, in my opinion, is it's $150 per person as members of the family. So they did change the rate slightly. That you can see, if I'm a single person, I would go from $605 monthly to $829. And if I go to the high option accident, it goes from $870 to $1192. And then if I'm family, low option is $1698 versus $2326, and on high option $2423 and $3320 respectively. To give you some context of what this means, though, comparatively, the Aflac policy does provide a $50 screening benefit, but their family rate is $56 a month, and their single rate for an employee only is $25. I think it's $25 a month. So this is a great benefit that would support kind of our initiatives when we do screening events. And because I've had experience where I've done these type of programs in the past, and then we basically, if they come to the screening event, we give them a voucher right then that they just go and claim their $150. So it's really, I was surprised as to how competitive MetLife came back and made this offer to us. The critical illness policy that's listed at the top that we already have, it also includes already a $50 screening benefit. So if they were enrolled in critical illness and accident, it'd be $200 per person.
And currently there isn't a wellness benefit for the accident, right, Randy? There's nothing, and it's literally going from 0 to 150.
That's correct.
Okay.
Yep, that's correct.
And is this something they would be incorporating in the new plan renewal, like in October 1?
October 1st.
Okay.
So we will be communicating. We had a lot of discussion and how we work this out with Blue Cross, but ultimately we settled on the idea of let's just do it all October, but it applies to everybody. So we'll have to be communicating with the October pool and the January pool that their rates will, if they're enrolled in accident, it will change effective October 1st. And then that benefit is available October 1st going forward as well.
So for the January premium folks, though, so mid-year for them, not quite mid-year, but October. So for the last few months of the plan year, theirs would also change?
Yeah, that was what I said. We had a long discussion with the underwriter on this. He wouldn't budge. You know, we said, look, we have 2 pools, 2 cycles. You know, we tried our best, believe me. We had many calls and discussions.
So because I'm playing devil's advocate, if you have employees that are currently on the plan, and they don't want to pay the additional
they
premium
basically
starting,
can drop, it's a plan change, so they can literally drop the plan. If
they
don't.
can as of September 30th or whatever the
Yes,
case may
they
be.
could.
Okay,
Those on the January pool, if they say, I don't like this, you know, $2 increase or whatever it is, they can say, I'll just drop the coverage.
okay.
Yeah.
And if I may, we can work with EV Tech to make sure that like an event is opened up so that just that line of coverage could be modified, much like an open enrollment event.
But if they would have no changes, they wouldn't need to opt in. It would
Right.
only be if they want to opt out. Okay,
Yes.
But if they want to opt in at that time, there would be a window of opportunity as well.
okay. If they wanted to, for the January folks, if they wanted to start the coverage sooner than their open enrollment, they could do that as well?
Because it's a financial change. I mean, I guess that's up to NDPHIT. Do you want to give them, those members who now have an opportunity to take advantage of it as of October 1 to enroll in it?
Special open enrollment, that would be another option that you could offer, a special open enrollment to those that are January that want to activate the benefit.
From an administrator's standpoint, I almost feel that's just another layer of crazy.
Yeah, it is. Yeah, that's the problem is that so it's easier just to say, if you don't like it, you can opt out. And then those that come in January, they can just opt in.
Yeah,
Okay.
And I think it'll be a lot easier for us to work that out with, you know, making sure. The reason that, just so you know, there's a filing issue. So when it's a certificate of coverage that they filed under the trust for this product. So when they make a change, an amendment plan change to the coverage, then it has to literally apply to the entire policy of all the policy holders. So that's why they couldn't change the structure between January and October. Just so you know, I mean, so they went through that conversation. I went through it yesterday, actually, just to make sure I understood why they could do it.
but truly, even with the premium increase, no matter if you're even in the family version, if you will, you add that up on a monthly basis. If you get your credit, you're actually still getting more money back than what you'd be paying the difference in premium.
Yeah, you could have a spouse and an employee go and get a screening event and they get $300, and that's a whole lot less than your premium increase.
And for the family piece, that also includes your dependents, your children.
So children could get a dental exam and have it covered.
Mm-hmm.
So anyway, that's that benefit, and this is just their content wellness site that they're going to make available to us to use to customize communications, promoting anything we want to relative to our, again, wellness and health initiatives that MetLife has a lot of content that would help us, and just whatever we want to do to kind of coordinate that with our other efforts. So, and this just gives you the current coverages, and I think everybody has seen this, and you know, from the coverages, also on the $50 wellness credit they get from the cancer critical illness policy that's already in place. So the next section is on our NDPHIT on-site screening credit. So we've been working with Blue Cross, as I mentioned in our last board meeting. Excuse me, made a proposal to them to cover the screening events that we want to do, that we proposed also at the last board meeting. So they came back, and this is what the structure is going to look like. They provided $100,000. We can have it divided in kind of two ways. One is we can use that $100,000 between now and the end of the year and then we reset another benefit into 2023 or 24, I should say. And or we could extend if we haven't used up all of our credit in 2023, then we would continue to use the benefit and then come up with a new number after this benefit is exhausted. But ultimately, the idea of it is we want them to sponsor more and more money towards this effort that we can do on on-site screenings. So that's kind of where we ended up. And also we're starting we have our first scheduled event May 1st, 2nd, and 3rd. And right now we are coordinating with Dunn County, and we hope to incorporate Kildare into that as well. And which would involve approximately 150 employees and their spouses that could be eligible to participate. And this is just the overview of what that process looks like. And I shared this at the last board meeting, so I won't go into all the elements of it. But one thing that we're also wanting to do is provide members that come $100 of their annual benefit of the Healthy Blue as a credit for participation. Just as one other kind of support structure to perhaps have them consider why they would want to come to the event. But again,
Randy, real quick, in regards to, and maybe this is a Brenna question as well. What are we doing to support Dunn County and Kildare Public Schools to be able to get the word out to their members? Are we doing any type of marketing materials, emails? What does that look like?
So there's a whole, in fact, we had a kind of an onboarding call yesterday with Desi at Dunn County to start this, but there's a whole communication structure that will start starting right away. As soon as, so we have a coordinator that works under Thriver that is essentially creating all the communication structure, the time frame and process, and they're working directly. And Angie was on the call as well yesterday. So this team literally comes in and they coordinate all the communication as well as the scheduling. They bring on the providers. They literally do every step of the way. And they kind of handhold the member group as to that process. And I've used this team in the past, and they're very, very good. My clients have really appreciated how organized they are and how timely, what they do, their whole process for the on-site screening events.
So are we going to have, I'm just thinking, to be able to kind of filter or be able to review what kind of marketing items are going through, because I really want to, we want to make sure that NDPHIT is at the forefront of this, be able to show our members that this is an NDPHIT benefit. And even though Thriver is putting it on, I just think it's critical that our members know and get to know that, NDPHIT is here for you, if you will, and making sure that communication is clear to them.
Yeah, so that's why I wanted Angie to make sure that she is at the forefront of that coordination effort and how the branding goes and how the communication process is organized and communicated out.
Perfect. Great.
So that's it's kind of the learning experience of the process, but ultimately, want it to be driven by Angie and the seat or the NDPHIT team that does it, so that it accomplishes what you just described.
So does any board members have any questions? Oh, I'm sorry, you're still doing the on-site.
Yeah, the other part is the follow-up to it, and I think I mentioned this last time, but Thriver is committing $120,000 a year, or 275 PEPM. So that includes the dietitian follow-up and also personal health coaching to all of the members that or any member that opts into this through the screening event, or any other process that is kind of broadcast out, as an offering to all the NDPHIT members. So we want to have pretty strong initiative to make this resource available and take advantage of, that commitment credit as well. So that was the last slide on that section.
Okay, perfect. Thanks, Randy. Does anybody have any questions, comments in regards to either the MetLife product enhancements that we're looking at getting that wellness credit, or anything in regards to the pilot project for the health screening? Okay.
Okay.
Well, if we want to move forward on the Blue Cross Blue Shield, the Alliance program updates.
Yep. So I shared some of this in the past, but we're keeping a close eye on this because they, as I mentioned, I think in the last board meeting, they stopped charging, that being Blue Cross, a Blue Alliance fee to all of our, to basically all employers, but particularly the trust. Obviously, that's what we were sensitive to. It's through this long series of negotiations that we've been keeping apprised of how they're restructuring their program, because we want to also account, even though they're giving us a 7-month windfall of not charging us, which we built into the underwriting. I'll show you those numbers in a minute. The important thing that we want to understand is what is it going to look like going forward, both on cost and the savings initiatives. I've had multiple meetings since our last board meeting with Blue Cross regarding this topic, and even as recent as yesterday, the actuary Tony. I think they're, as much as they're trying to put a number out there, what they think it is on cost. I think that they're still kind of in the development of really, the final process that's going to be deployed. The goal of Blue Alliance, if you'll recall, is that they want to have providers incentivized to be involved in kind of a medical home and preventative care initiative. And they put them at standards of performance. And if they meet the standards of performance, they pay them additional money for that performance. If you recall what I said in the last board meeting, we started this 1.5 years ago with them. And we said there is no tie-in of what you're paying, what the employer groups are paying for this versus how they actually perform. And they decided they basically concurred, and they withdrew the whole program. Because, and it's just not NDPHIT, it's all of our self-funded groups that we have throughout the state. I just said, no, we just cannot do this anymore. And for NDPHIT, you're talking over $1 million a year that we're paying Blue Alliance. So with that withdrawal, obviously that's great savings, but we're just concerned about how it's structured going forward. And even as recent yesterday, Tony was pretty elusive about what their cost structure is going to be. So we basically are taking the conservative approach in our underwriting and building in what we've kind of had historically, pain, and because we just, he said it's going to be less, but we just don't know. So we have to take the most, like I say, conservative approach and build our fee in as what they did. So what I'm referring to is the fee starts over in July of this year. There's no fees charges, from November to July. But going forward, there's going to be some fee allocation. So anyway, that's kind of the assessment there of and what they're really trying to do with the Blue Alliance program. It's the idea of an added value function. And you have all this detail in the slides. I won't go through all because I did it at the last meeting.
And Randy, just as a reminder to the board, this is where there was such a differentiation between entities that Blue Cross Blue Shield is working with, correct?
That's part of it. Yeah, we see.
Okay.
There's really two parts. The rebate is one area, and then the Blue Alliance. In other words, our cost for Blue Alliance with even our two pools is dramatically different. The October pool is far less than the January pool for Blue Alliance. So it's all based on this attribution model of where people go for care and how they've structured their incentives with providers. And that's, so there is a big differential, and it's a different of other groups as well, to your question. So this is where they want to be, is, you know, they want to have it as, you know, they want to have these performance targets in place. They want to have quality metric redesign reporting for employers, but I haven't seen it. So just so everybody knows, this is what they represented that they want to get to, but we just have not seen it. And we have, you know, we're holding their feet to the fire by producing what we call KPIs relative to this, which is key performance index, and indicators and reports that are really going to validate this reporting for employers. Because to date, we don't have any of that, but yet we get charged a fee. So, and then just so you know where our savings are, we calculated kind of our projected. So this is actually what we put in underwriting, that you get an idea on. So we put in underwriting for the January group, $49.94. We put in the October original group last year at renewal 1967. The actual cost for each of those pools is less because they delayed that. They essentially stopped charging us. So the ultimate savings, when you count the two pools, is a little over 600,000 that we gained as a windfall to it.
Randy, what is their explanation? I mean, it kind of blows my mind that they're charging $49.94 now, and they can reduce it by, you know, down to $10.94. What was their reasoning or justification?
Well, this reduction has to do with the fact they stopped charging us. So,
Okay.
So we got that 7 month, I mean, basically January to July is that, because I counted this only in this current time period. But it's a hard question, because when I went with the last meeting with Kyle, we addressed multiple issues. This was one of them. And I think they could see Kyle was very frustrated because they can't give good explanations when you bring up, you know, the details of, or to try to explain, you know, even why is there's a delta 49.94 versus 1967 in these populations. They can't tie it to anything.
So it's not age-based or anything like that,
No.
where like maybe our January pools have a, you know, higher age group than October pools or something. There's
nothing that they can show you on any report of, you know, where we went to hospitals, where we went to providers, what the performance guarantees or the performance structures for the KPIs were to those providers. It's basically said, here's your bill, pay it. Nice, right? I mean,
right.
it's just absolutely frustrating. So we're hopeful, and they have committed that they're going to be putting out this KPI report format for employers, you know, prior to the rollout. We're holding our breath for it. And I'm not being facetious on this. It's a little frustration because we've gone over it multiple times, and we're hopeful because they have they put us, they've shown the commitment to put us in front of the right people that are working on various elements of this. So we'll just keep everybody apprised as this moves forward. But for our kind of our effort to, for underwriting, we're going to be conservative and just say, well, we're going to put numbers in there that are conservative so that if it's higher than what they're going to project, we have the way to cover it.
And so even though they don't have a plan yet, we are anticipating they will have something in place by the October renewal date.
Yes, that's correct. Yep. And so this is about pharmacy. Now we're talking about pharmacy. So the cost trend for the outpatient pharmacy, and this is the industry update. This is important. We get this, so we do a summation every year through Siegel. What is Siegel? Siegel Actuarial is where they subscribe to, there's over 100 insurance companies that use them as a data source for estimating future costs. and what's the market underwriting that they need to account for as a carrier. So we use the same kind of resource through Siegel. So cost trend for RX is almost approaching 10%. This is our biggest challenge that we have, and here's the reason why that we're getting a 10% trend on RX. Outpatient prescription drug, which includes the PBMs, the name brands, the generics, biostimulators, specialty drugs dispensed through retail, mail order, specialty management pharmacy channel. That's where it comes from in the sourcing, but there's this inflationary component that I'll show you in a minute. But it's being driven by drug product inflation, which is outpacing even the inflation we see historically as a overall inflation rate. More effective and expensive new drug therapies. And this big one that I'm going to talk a little bit more about going forward, which Siegel identified as obesity drug treatment with the GLP-1 mechanism, which was originally targeted for diabetes. It's called off-label medication prescribing. And the biggest one, and I showed it at the last board meeting, but I got a lot more insight over the past few months of researching it. But Ozempic is number one. If you look at our data, we had a 265% increase in Ozempic for our plan to the tune of almost $500,000. And it's become a social drug instead of something that was designed for, which was diabetes. Specialty drug biologics have a higher projected double-digit increase trend at 13.5. They now count for more than 55% of the spend, and our group is no different than that. I think, in fact, one of the pools is 60%, and it's driven by autoimmune, oncology therapies, and diabetes. And it typically, just so you know, that usually is about less than 1% of our population that is costing almost 60% of our spend in those specialty areas. In contrast, projected non-specialty drug is 3.2%. The manufacturer changes that are occurring, legal decisions that impact plan design, and kind of ongoing repercussions of the pandemic are also contributing to that 10% trend. Here's a big one that actually, in collaboration with Blue Cross, on my question of exploring rebates. Why are we not getting the same rebate level that our other groups are seeing? And we have such a big disparity. To your point, Jenny, you asked the question. This is the other area that was a big difference. And they explained to me, and I also, this is out of the Siegel report, it says it specifically. The 340B hospital programs are eroding private sector rebates provided by the PBMs like Blue Cross Blue Shield Prime. Hospital-based providers referring patients to a system-based hospital impacting the private rebate market. What does that really mean? Who owns the hospitals in the marketplace? Sanford, Essentia. When they have providers that send patients there for even a specialty drug, particularly, they have a 340B pricing. And that basically undercuts the pricing of the PBMs, where that's Prime is a PBM. So if they go to those other sources, that being the patients directed by providers who work for those entities, it basically takes money out of the pocket of the private sector, or in our case, for our own trust. We're losing rebates and rebate dollars. And so the more that you have providers that do this referring process. So how do you get around it? Well, that's why, and I'll show you in a minute, one of the programs by Blue Cross that they offer is a specialty drug vendor relationship that is exclusive to them, that allows for, the provider can't just say, well, I'm going to send you to the hospital to get the specialty drug refilled. They would actually use the specialty drug relationship. And when we did this with Grand Forks, because I mentioned to you Grand Forks Public Schools, we're getting rebate guarantees this year at 70, and next year it's 110 per employee per month. That's huge. Well, the reason why is because Blue Cross opted into this exclusive specialty drug vendor relationship with Blue Cross. So you can't just refer to the hospital 340B program. So the other thing is the 77% increase in the number of type 2 diabetes diagnosis for children in the first year of the pandemic. That's impacted it. The FTC probe into the practices of the Inflation Reduction Act. They thought the Inflation Reduction Act, would so what that really says, just so everybody knows, is that it's more focused on Medicare and Medicaid on the pricing that they're getting through the act that occurred. And what happens is if those manufacturers take a lower price from the governmental entities like Medicare and Medicaid, they have to cost shift that back to the private sector because they want their money. They're counting on a budget process. So anytime you're creating a deflationary component and enforcing it by regulation in the government sector, it has the opposite effect to the private sector, who's actually going to subsidize the government in effect indirectly through that act. So the private market is expected to see the average wholesale price for the brand name medications increase as a hedge against their impact on potential changes in the federal regulations, and particularly related to the Inflation Reduction Act. So,
hey, so Randy, hang on 1 second. So I just, not that anybody needs my confirmation on it. This is Kyle, but we just had this presentation from a state standpoint in our human services budget, and the increase in the pharmacy costs is you're doing a good job, Randy, and probably going over people's head a little bit on this, but it's just a real challenge going forward with the cost of pharmacies, especially, Suboxone is used for opioids, et cetera. So I don't know what the solution is long-term on this, but I'm glad you're on top of it.
Yeah, I mean, this is a major priority for us. That's and we mentioned a couple of our initiatives. And like, for example, we, as an update even to one of our initiatives we talked about before about Remedy RX. Well, they're actually now in negotiation with Prime Therapeutics at the corporate level, which if they initiate a contract, that would be a great windfall for us, that being the trust. So it's like a chess match. To be honest, we have to stay ahead of it in the chess match process. That's the only way I can describe it. So you can see what our spend is for pharmacy to our total spend. So 24% of our entire spend is related to pharmacy. I would say our typical group is between 18 to 20%. So we're higher than what we generally see as a percentage of total cost. But you can see the specialty drug inflationary components that are listed there. The specialty drug, increasing to 13.5 versus prior year, slightly less than that. And then the overall increase at 9.8 and 8.4 for 2022. So here's our top kind of drugs that are being used, that you can see and what we're paying, average paid per script, and then how much, per member. So what's important is really what the plan's paying per script. So Stellara, we're paying $23,000 basically for on an average, if you look at the number of scripts. Ozempic, as I mentioned, that $680,000. It was slightly less than 200,000 last year alone. So just the top 20 represents a $2 million increase to our spend as a trust over the last year. Then you look at also we broke it down by what we predict based on the case mix of the Milliman data for demographics, clinical markers, comorbidities, and Medicare adherence. Our population on the current risk index for the top chronic conditions is 1.19 listed at the top, and it's going to increase. So the average of a population is 1. So if we just look at chronic disease population within the trust, we're 19% above the average in our current chronic condition index. We're projected to go another 2% into the next year. So what's happening is our population is getting sicker. And what's driving it are demographics, clinical markers, comorbidities, and the lack of Medicare or medication adherence. And you can see some of the top areas, like I highlighted depression-related disorders, diabetes, and obesity. Those all kind of go hand in hand, honestly. So obesity drives typically your diabetic, not always, but there's a high correlation between the diabetics, the obesity patients, and the depression-related patients. And then we also broke out the pools to see what the difference is. So if you look at the January pool, we're at 1.36, 36% above the norm, projected slightly less than that. Still, it's 33% above the norm for the pool in January versus our school districts at 1.0. You're just slightly above currently, but it's predicted to actually increase. So if you look at the areas, and when we get to the population health slides, keep this in mind because it's the idea, and Jared will talk to it, I'm sure, but it's keeping the healthy, those at risk, managing those risks, your chronic disease individuals, managing those more effectively, and then trying to mitigate those that are going to get to the highest level of risk, which are high cost claimants. So Accredo is what I was referring to as the specialty medication group that Blue Cross contracts with for this exclusive kind of arrangement. So we're doing a study. They initially came back and said, well, it's only 56,000 or close to 60,000, I should say, in savings. But when I talked to Blue Cross about that, they said that does not include the rebates. And then, so we, for an example, we looked at one of our groups that they gave us the full analysis on. And if we apply that same kind of savings to what they represented, it's West Fargo Public Schools, I'll just tell you. It was about a 7 to 11% savings. And so if you look at that on a $13.8 million spend, that could be, and we don't have the numbers yet, but it could be $900 to $1.5 million in savings. Now we look at disruption, we look at, because we don't want to have people be impacted by a disruption process. So there's lots of things that we have to go through as the analysis still, but we're trying to go through it to come up with a recommendation eventually to the board as to that option and what it might look like. They also have the Flex Access program, Blue Cross being, that's coming out in third quarter of 23, Meds to You, which is an Amazon program, and then another program called Net Results. So that's all part of our analysis that we're doing right now to come forward with a recommendation. So going back to the question we asked earlier, so I worked with Tony to come back to say, look, we're not getting the rebate structure that we were projected. When I say projected, the differential that we see with our other groups is the better way to describe it. So I gave him all of our data, and he went back and looked at the actual NDPHIT groups and versus what we put in underwriting. And then the forecast of basically using updated data that he provided us. So we put in a credit of $43.49 per employee. He actually said we are running at $61.72 for the January pool. So it's an additional rebate of $18.23 per employee per month. For the October pool, we put in originally for this year, it was $18.13, and that has now been adjusted to $33.55 for the October pool. So it's another $15.42. So you combine those two pools together, and it's basically that increase to the rebate is going to provide almost another $600,000 as a rebate structure back to the pool, which is another positive thing. And we are monitoring this, pretty much monthly. To ensure that these rebates are staying current with what they gave us as their updated number. And then this gets into that Ozempic discussion. So last year we paid $189,000. Now it's this $680,000 this year, $680,000. Actually, I take that back. It's 2021 compared to 2022. It was a 259% increase. And it goes to this off-label prescribing medication structure. So what happens is a provider they have a drug that's out there and they use it. It's been put out in the market for one reason, but it gets prescribed for another. Ozempic is the classic because you saw how much social media has been out there about weight loss to Ozempic. So ultimately, Ozempic went from being a diabetic drug to a weight loss.
And Randy, I'm sorry, I have to jump in because our team does a lot of work around metabolic syndromes and Ozempic. So I just want to highlight that depending on your PBM and your carrier's prior authorizations, it's very difficult to get an Ozempic prescription without a diabetes diagnosis as the primary diagnosis. So there should be. Sorry, go ahead, Randy.
Yeah, no, thank you. Because I actually got to Crystal, who's the head of pharmacy at Blue Cross, and asked for all of the pre-auth requirements.
Yeah.
It's very broad. It's not restrictive. I mean, they have their guidelines and then how many pills you can get. But the way that the guidelines are structured, it's pretty open-ended. Because different carriers have different guidelines based on the PBM, that they have that relationship with. So Crystal sent that all to me. I looked at it and I came back and I said, and then I actually talked to physicians. I said, you tell me how easy it here in this market is to prescribe Ozempic. And almost without exception, they said it's fairly simple.
Well, yeah, there's a difference between prescribing it and somebody getting that prescription filled. So just want to point that out. And I think that that's an opportunity to audit those prior auths. And that may be something we can help with, and also something that we're keeping a close eye on. And as we talk more about diabetes and metabolic syndrome in your population, that Ozempic may be, a helpful tool along with behavior and lifestyle changes, because we're monitoring what that return on investment is, so that people aren't, increasing their other comorbidities and chronic conditions. With the understanding that yes, currently is huge expense, but there's other factors at play.
Yeah, and so the other thing that I was trying to evaluate as part of it is, is it just a provider prescribing it? And there's really not a holistic approach to say, well, let's assign you a dietitian or get you through a program structure so you're focused on the behavior component as well as the prescribing of the drug. So those are all things that we looked at, or that I looked at as part of the analysis. And this is just an explanation of what off-label prescribing is, and it was pretty well, again, verified that it is occurring, particularly with this drug. And so this was written actually by PharmD as to what the analysis showed. So I showed this in the last one that said, and this is what I also had a discussion since our last board meeting with the pharmacist team at Blue Cross. I said, okay, you can get Ozempic at a 30-day supply. Here's your cost. You can get Wegovy at this, which is another semaglutide GLP-1 agonist, or you can go through a compounding pharmacy to get it. So there's a huge difference in pricing. And I said, because actually Blue Cross is actually investigating this as well, because they realize there's this huge pricing differential. And so I just did the analysis to say we have 102 members on it. If they use if they got 20% utilization of those individuals using Ozempic and using a compounding pharmacy for the dispensing structure, and I'll describe what a compounding pharmacy does and how it works. But basically, the price difference, goes down significantly. And it's about $163,000 savings to the trust and about $19,000 to the member if you make it at no cost for the member, and the $225 that the compounding pharmacies dispense it at. So what is a compounding pharmacy? This is something, again, that I reviewed and went through with the pharmacy team at Blue Cross, but it's basically, it falls under a 503A facilities under the FDA, and they have to be specific and licensed to every state. So in North Dakota, there are actually several licensed compounding pharmacies. So examples are Hollindale, Wells, Create, but there's other local ones too. And they comply with all the state boards of pharmacy regulation. That they have to meet all these criteria. And so and in the case of semaglutide or GLP-1 being dispensed, it has to be under a DEA license of a provider. It has to meet all the same criteria, basically, for that. And the regulations restrict compounding pharmacy from making a replication of the patented therapeutic, so you can't replicate, an Ozempic, even though the ingredient is semaglutide, it has to be actually a different compound. So the last one is there are North Dakota DEA licensed providers currently through one of them here that we're already contracted with is Medalis, and they do prescribe it and would offer it at the $225 for any patient that met the criteria, because there is strict criteria that you have to be able to meet for eligibility and clinical contraindicator assessments that they do. And if they meet that criteria through that process, then they can be prescribed. So I bring this up because, if that's available and someone goes to, uses, Medalis as a place to get their sourcing through it, and ultimately it's the compounding pharmacy, but the cost would, for that patient would be $225 for the trust versus what they pay through the PBM. So, any questions about that?
So, Randy, can you go back to the, I don't know, the area where like our top conditions? Yeah. Maybe the slide just before that. Sorry, forward, I mean. Okay. So if people are just using when we have the like diabetes, for example, is one of our higher, I guess, diseases that we've indicated.
Yeah, 459 members.
Yeah. So when we look at those costs, are the costs related to untreated, like I'm not using a medication or I'm not doing what I need to do, or I suppose we don't really know that. Is it a combination of those things?
Yeah, there's a different report through Springbuck we can get to show you that. It's called Gaps in Care. So I can get to the diabetic section and I can run a Gaps in Care report. So how many are compliant to A1C tests, as an example? And it shows you the projected gaps in care. And I actually have an example of that a little bit later in the slides that show you what our cost is by gaps in care.
I guess I'm thinking like, okay, well, and obviously Ozempic, I mean, I've heard of it. It seems like, it's like everybody wants this drug and for anything but diabetic issues. So I guess if it's gone up 259%, I think is what you had, then in a perfect world, those 459 people are now maybe using that a bit more and controlling. So we should see a decrease in
cost.
Maybe.
Yeah. Well, that's now you bring it up. That's the big cost. How much value you getting out of that increase?
Yeah, I mean, I don't know.
It's I think to Kelly's point is there's lots of factors that go into it.
Yeah.
There are the clinical efficacy related factors that actually benefit. Because if you lose weight as well as manage the insulin levels, that's really what it's designed to do, is to manage insulin levels through the body receptor process. And it does. There's lots of massive studies on semaglutide and GLP-1 and what it's been able to do through the brain gut process. But how much is it really mitigating? We don't have that number. Let's just be honest.
Yeah.
So what we do know is that it costs a lot for the drug, and if there's alternatives and people take advantage of the alternative and they get the same clinical efficacy, then it should be made available to them.
Yeah, and to your point, Brennan, as far as, do we know if the use of semaglutide is going to drive outcomes for your particular population? That would require us to have some biometrics for those people. And the current reporting that we have is claims related. So we won't know if it's helping them to manage their diabetes, but we might be able to see if maybe people with prediabetes diagnoses come out of that pre-diabetic state. And there are cases where people are able to reverse their diabetes conditions. So that is something that we'd like to, keep an eye on for longitudinal efficacy.
The other question I had is, when you had said, is there alternative prescriptions to Ozempic? Is there something else out there, or is because Ozempic is the new shiny, everybody needs it. That's what they're prescribing. Is there other options?
Yeah, there are other, that's why I say the compounding pharmacy GLP-1 is an alternative. And it's significantly less. And it's just dispensed through the compound pharmacy versus through the PBM. That's the difference. And it's sent directly to the patient based on the prescription from the provider.
All right, but to answer your question, it is the same drug. It is semaglutide still, just
semaglutide. It's semaglutide. They have to meet the same core ingredient to meet the standard. They won't ever come out and say, well, this replaces Ozempic, because they can't say that because of the patent.
Because it's still under patent. Yeah. So there's no generic options directly. Yeah.
It's like a generic option that says, here's your generic option instead of paying through a specialty drug, and it's coming from a compounding pharmacy. And that's why I referred to Medallis is really the first one that's making that available through a compounding pharmacy here in the state. And since like I said, since there's already a contract in place, they would offer it at the $225.
And there are a few other options of GLP-1s like Mounjaro, which is produced by Eli Lilly, but they're all in the same price range because they're still all under patent.
Exactly. They're all in that specialty drug category.
How do you ever rein in pharmaceutical? I'm just like, it's no different than when people were prescribing opioids, and we create, like, people find ways to get, like, I'm guessing that how are people, if they're not diabetic or pre-diabetic, they're still, clearly some people are getting this just specifically for weight loss, across the country or something, right? I mean, how do you ever?
I'll add that Ozempic is authorized for use for diabetes. Wegovy, which is still semaglutide, but in a slightly different dosage, is authorized for use for obesity and for people in an overweight category with one other comorbidity like hypertension or hyperlipidemia. So there are exceptions, and the clinical use for semaglutide are increasing. If somebody is not able to get prior authorization through your plan, then they may choose to self-pay. And there are also Canadian pharmacies that are making this available at a much lower rate or cost. So people are exploring other ways to find it. But, in theory, if your plan is running the way it should, then only people that are meeting those clinical guidelines are getting an Ozempic or Wegovy or Rybelsus prescription, which Rybelsus is an oral delivery. The others are subcutaneous pens.
Yeah, but there's no question, based on kind of the most recent analysis, as I shared earlier, by the industry, the GLP-1 through a social kind of promotion has increased utilization to it. Even though it's the idea that it meets the clinical efficacy, it's still the description of off-label prescribing. And the providers I talked to, again, they said it's exactly what's happening. We have patients coming to us, and asking for it. So anyway.
Right. I mean, Novo Nordisk and Lilly and all the others are in the middle, and we're targets of it too, like a broad educational campaign. So providers are learning about it. They're trying to, they're learning all of the clinical studies. And it's out there in the social medias and other medias as well. So like any other new drug, there's a huge campaign for it, and that creates the direct consumer demand. So it's a little bit of the same old story, different day.
Yeah. So any other questions on this section?
Just real quick, Randy, if there are no other questions, how's everyone feeling? Do you guys want to take 10 minutes or push through?
Just curious on how, I mean, I look at the agenda, I'm just wondering, a lunch at some point, are we?
That's what I was wondering, if we want to take, do we want to take a 10 or 15 minute break? And then if you want to grab your lunch and bring it back, we can finish the meeting that way. maybe just let's take, what, 10 minutes, 15?
Because the rest of the agenda is probably only 30 minutes total. So if you,
Why don't we just take 10? So let's look at coming back at 12:40, we'll say. We good with that? 12:35?
Sounds good.
That works.
Okay. So let's shoot for 12:35. We'll see you guys. Yeah, let's take 10.
It works.
Go to your Teams meeting. Or no, sorry, Zoom, your Zoom button down there.
Which one?
Your Zoom.
Zoom, right here.
There you go.
oh, it's up here.
Where's your-
And then we will share screen. And I think I have to go to display setting again.
It looks like this.
Well, I would tell you guys that the more I sit on these Teams calls, the more I don't know nothing about insurance.
We were just kind of saying
Yeah,
that.
we're talking the same thing.
I was like, I've taken some high level math classes and accounting classes and my head was confused, but this health stuff, whew. And I didn't even have a beer doing this. At least when I was in college, I could have a beer while I studied that stuff.
Especially since we've been up, some of us have been up since like 4 a.m. with stormy weather. So. I needed that break.
I think we all needed 10 minutes just to kind of recoup. It is a lot. It is definitely a lot of information. It's just disheartening to see the amount of prescriptions that just in a general comment sense that everyone, it's like, it seems like instead of doing the right thing for your health and wellness, it's here's a pill.
Yep.
And I just kind of feel like that philosophy is becoming more the norm rather than really being proactive in your health. And that's
our culture. Yeah. And nobody wants to give up.
There you go. That's right.
yeah.
I did an orange and a banana for their snacks here, so.
Right.
Banana.
But then that 5 feet of snow outside doesn't really help our activity level.
No. No, agree. But it's just, I think if we could get off of there's a pill for everything and actually try to incorporate some more healthy habits and just even mental ways of, I mean, I think even this entire winter is everybody wants to move to Arizona. I'm just saying, because it takes a toll on you. And I just wish everybody wouldn't be so pill happy and trying to fix issues, because that's not. And the sad thing is most of those pills, when you think about Ozempic, I love how pharmacies can commercialize how wonderful it is. And as they're talking about all of the side effects from, depression to suicide to whatever, and they're on a boat sailing and they're waving to their neighbors. And it's just, it's like, ignore what we're saying, but look how happy you can be if you take this pill. But anyway, how are we doing with folks being back? Do we have everyone pretty much back? It's hard to see because I'm not sure when we're in presentation mode, but
Let's ask everyone who's not back yet, who's not back.
they wouldn't answer.
I see pretty much everybody.
Okay.
I don't know if Kelly is time. Is she gonna talk next?
Jared.
All right, I'm here.
Oh, okay. They just had their video off.
Just eating.
Oh, you don't want to share your eating. Okay. Yeah, I think everybody's here.
Okay. Well, Randy, if you want to keep moving forward on population health.
So the next one is served up to Kelly and team. So I'll turn it over to them. Let me see if I can minimize this so it's not in the way of the slide. How about that? All right. Kelly.
Thanks, Randy. And I'm gonna just quickly turn it right over to Jared.
All right. So we wanted to take just a moment to level set, remind you kind of where we are coming from. We've had a couple of meetings in the past 9 months. In one of the very first meetings, we discussed NDPHIT's workforce goals and objectives. We went through this exercise. And we don't need to go through this detail for detail, but take a look, on the left-hand side, you're looking at the higher level business goals. These are goals that are dream goals, right? These are things we want to accomplish. And the health and well-being objectives on the right are really the steps to get there. If we want to control the cost of benefits, we need to manage and control drug spend. and medical spend, et cetera. So, as you look at these, you can kind of pay attention to, the main goal on the left and the steps that we're working on to get there. And so as we have been working on analyzing your population health as a whole and making recommendations, these are the overarching goals and objectives that we have been adhering by. So any questions on any of these?
So, sorry. Do you want to do advance?
Well, if there's no questions, then yeah, go ahead. Okay, so again, to kind of remind you and update you from our December meeting, as we came in and provided a little bit of an update and analysis, as well as some discussion. These were the 4 next steps that we left off with. And so we wanted to share with you where we're at. The top one was biannual attendance to your meetings, which, here we are, right? The second one was mental health strategy check-in with E&I. And we're happy to report that we have met with them in detail. Later in our presentation, we're going to talk about what our conversation entailed, what recommendations they had, and what recommendations we have in regards to the mental health strategy and involving E&I in that process. What we're still working on are routine meetings with Thriver to collaborate on our strategies, as well as identifying some of the gaps in care. We're working with them to put together a meeting cadence and stay on track. The holidays kind of threw, I think, everybody off as far as that's concerned. Something we're also working on that was part of our next steps is designing a key performance metrics dashboard for you. This should be available, or at least we should have some more updates in the next board meeting. What we're working on here is in specifics with E&I and your mental health solution. Being able to monitor that, this is really taking a look at the major issues that they're seeing and providing an update from a high level, of course, the identified, really just to show you as a board where they're having an effect and where possibly strategy can adjust or align. So any questions on kind of where we're at and what the next steps are? All right, go ahead and jump forward. As I mentioned, we did have a chance to meet with E&I, and we had a long conversation with them. We asked a lot of questions in regards to what do you do for other clients? We know E&I's capabilities are vastly different and more extensive than a traditional EAP service. But one of the things, you're a board, you're a collective of organizations, and that's not necessarily something that EAPs are typically used to working with. And so we wanted to meet with them and have a discussion. What do you usually see with organizations in these industries and groups such as yours? And what do you recommend moving forward as far as enhancing that EAP, increasing the engagement, getting the message out there, and really having an effect on the individual? And so what we came up with was some communication targets. As you can see here on the left, starting at the top, some monthly communication strategy targets. And that could include, of course, with the board's approval, that could include virtual benefits orientations for new hires and re-education for any individuals who want to brush up on the offerings. Monthly newsletters that can be sent out, or each entity can opt into that if they would like, and redistribute that to their employee base. Monthly setting a cadence to meet with our team, Angie and E&I, to review status, where things are, where things need to be, how the communication plans are moving forward, any changes or updates or enhancements that are being provided along the way, as E&I, of course, continually increases their ability and resources. Also monthly, they recommended organizational trainings, such as mental health first aid, stress management. We have a few recommendations of our own that we'll get to here in just a bit. But that's the monthly cadence, something every month and a check-in every month. Really, that's kind of the idea that we recommend to keep the EAP and mental health fresh on everybody's mind, and to stay on track of it in regards to the trainings and the resources. On a quarterly basis, we recommend utilization review meetings. Who comes to these meetings is yet to be determined, but you know, it could be Angie and the B&B team and E&I. If you have a subcommittee you wanted to include in these utilization review meetings, we can do that as well. We also recommend benefits orientation and a mental health training for supervisors on a quarterly basis. You know, whether or not you want to require that for supervisors, whether or not it's, you know, a yearly expectation. That's, you know, if you're going to provide a robust, utilized mental health resource, supervisors are one of the best ways to get to the employees, because they're the ones that work with people on a daily basis. They're going to notice those signs and those indicators that maybe something is up with an employee, and those mental health first aid trainings are a great way to educate those supervisors on ways to not only notice and recognize those issues, but also ways to address it and refer in a non-confrontational way. So we recommend that supervisors are you know, engaged in these trainings, you know, at least once a year, but you know, offering them quarterly should hopefully give everybody a chance throughout the year to break some time out of their schedule and attend a training. On an annual basis, we recommend an annual review with E&I, an annual planning meeting, taking a look and reflecting back at how things went the first year and what changes and what the future plans are. And of course, included in that would be a communications planning moving forward. So any thoughts or questions on this recommendation for mental health strategy?
Jared, this is Jenny. Just a couple of things as I'm looking at your monthly. I love the idea of doing a monthly newsletter, just because I think this is a new benefit for employees. And yes, we talked about it in open enrollment and maybe mentioned it in January when it started, but I think this is just kind of a nice reminder to give those members, knowing that that's a benefit. When you talk about organizational trainings, are these like pre-recorded or are they more like a live webinar?
Typically both. Typically they're broadcast live and then recorded, and then a link can be sent out for those who missed it and wanted to watch it.
Okay, just a suggestion, have no idea if this would work or not work, but thinking about, you know, when we've had other trainings with Thriver where they've come in, like there's an email that goes out the day before, hey, tomorrow is a XYZ training. And a lot of our employees have said, gee, it would be nice to have a little bit more of a notice, or is there a schedule? And I don't know if this would work or not, but, you know, maybe it's the third Thursday of every month, you know, that E&I is doing their monthly training on whatever. And so maybe that would be a way to give employees a heads up that they know that the third Thursday of every month, E&I does their monthly training, or at least give employees maybe a week ahead of time notice, just to be able to plan for those. Because I know that's been a comment that I've heard from a number of our staff in regards to being able to attend the trainings, is there's just not enough notice. So a couple things to think about.
Yeah, absolutely. And those are absolutely perfect points. If we want to get the most engagement out of these resources and these organizational trainings, When we sit down and work with E&I to create that communication plan, we'll likely want to plan a good 6 months to a year in advance, and ask them to put those in their monthly newsletter, and ask them for a certain amount of reminders, maybe a month in advance, maybe 2 weeks, and then the day before, etc. So great thoughts. All right. Go ahead and jump to the next slide for me, Randy. As a, we talk about creating those plans and those monthly and quarterly and yearly targets. We put together kind of a sample for you, just because hopefully it makes it a little easier to really look at this from a standpoint of not only what do we want to do and how often do we want to do it, but who are the audiences? What channels and methods are we wanting to utilize to communicate these specific items? And then who's responsible for distributing the messages? Who's responsible for the graphic design and the content? Which, in the mental health, we're gonna likely lean a lot on E&I to provide us with those type of resources. So it's, but we want to make sure that everyone involved knows who's responsible for what, and when the target dates are that we're trying to have these items take place. So this is fully customizable. This is not set in stone, but we wanted to at least provide you with what it could look like, and this would be part of that communications planning, where we would put this together and really tailor it to NDPHIT. So there's no questions. Go ahead and jump to the next slide. And thank you. So as I mentioned before, there are a handful of different organizational trainings that E&I has ready to go, that they can do. We looked through the list, and we'll share that list with Angie and everybody that would like to look at it. After looking at the list, these were 3 of the trainings we felt that would be very beneficial for your industry, for the individuals. Balancing work and life, managing stress, and learning some positive coping methods, and then resolving conflict in a rational and effective manner. So those are 3 examples. Of course, you don't have to take our word for it. You can feel free to take a look at some of the other options. But these are the types of trainings that E&I would provide on an organizational level, or they did mention that, because it's split up into so many various entities, that different locations could enhance and do their own trainings. Of course, we'd have to work with them to arrange something like that. But keep that in mind, that there is a lot, and it is something that can be a little bit more customized and individualized.
Jared, how long are the trainings? Are we looking at a 15-minute kind of quick lunch and learn, or is it a 30-minute, an hour?
I believe they're between 45 minutes and an hour, but then again, E&I is open to customizing that. So if you are only really able to pull people together for 30 minutes, they can trim it down and make it a little bit more bite-sized, that people can watch during their lunch. But definitely a conversation that we can bring up and know that E&I is very flexible as far as these trainings are concerned.
I don't know for the rest of the board members, but I think about how precious time is to everyone, and you want to be able to offer this kind of a benefit to your employees. I could see an appetite, at least for our staff, like maybe no more than 30 minutes, just because, I could go over a quick lunch hour. You're able to carve out a half hour, but I don't know, sometimes 45 minutes and even an hour can be a lot. And it's like, if there's nuggets of positive ways that we can help our employees, maybe considering that, but I don't want to speak for the entire board. I'd be curious to know what your thoughts on that.
I think I would agree. One thing that maybe would be helpful just for flexibility, I'm thinking in a school setting, would be able to, the ability to have these, maybe they're modules that we could sort of plug and play when needed. So I don't know if that's an opportunity to develop rather than being live all the time, because live, I think in all of our schedules, depending on your organization, could be challenging to get everybody there.
I agree with you. Working in a school district, a lot of times, it'll come across that it's 11 o'clock presentation or something, and our teachers obviously can't stop teaching the kids at that moment. So I like the idea of recordings that they can watch at their convenience. I could be an initial recording at like say 4 o'clock or a meeting at 4 and then have recordings available.
Yeah, definitely something worth having a conversation about. I don't see any issues with that. So.
Yeah, and typically E&I and other EAPs will make a recording available for a year, and it's hosted on their own domain so that you can't go and, repost it anywhere, but we would make sure that that is linked for you in your other intranets and something that you could use and reshare wherever makes sense.
Excellent. Well, that's our update as far as the items and the takeaways from our previous December meeting. But that's where E&I is, and we're moving forward with all of those specific items. Next steps would be setting up a meeting with E&I and including Angie in that and starting the planning process.
Great. Thanks, Jared and Kelly, for your update on that. And it looks like we're moving in the right direction. So Randy, are we ready to discuss our stop loss incentive proposals?
Yep, this is the next section, and Jared's actually shared this slide before, but I'm going to show it because it's relative to how we are making our stop loss proposal. Because it's this is just this idea that you have your healthy, at risk, rising costs, and then complex patients in your populations. And it's what I really wanted to get to is to show overall. Now, the last slide I showed you like this was relative to chronic disease individuals. This one is a little bit different, where it's describing the entire pool for medical and for pharmacy combined. So that when we look at if you remember, it was actually higher just on the chronic disease individuals for the CRI, which is the current risk index, versus the predicted risk index. Again, using the Milliman standards for how they're looking at this analysis. And for those who don't know, again, Milliman is a national actuarial firm where they track lots of data relative to acuities of populations and predicting risk. As well as cost. So when you look at, and this is all comes from our Plan IT reporting platform that we have Brown & Brown, where we've incorporated the Milliman index structure into our report. So you can see we're at 0.92 current as overall population. There at the top, going to 0.98. So that's on a value of 1. Overall for medical and pharmacy combined, that's where we're at, and how much we're paying per member in the trust. Now, if you break out the two pools again, January versus October, we're at 1.1, and it's predicted to be that way on the population in the next year. The average cost though is $7,321 per member. You go down to the pool in October, it's 0.77, but projected to be 0.87. So that was kind of an interesting fact, but also it is still 39% below the January pool group in terms of cost. But the areas that are predicted to increase, which is kind of interesting to observe, it's the lowest cost category. So if you look at low risk that I highlighted there, and then again, compared to a value 1. So going back to the slide earlier where it says keeping the healthy. Well, what this is saying is that your healthy population is actually going to go from 0.42 to 0.61 using the historical data and using demographics, clinical markers, comorbidities, and Medicare adherence. So this is important. to not only for measuring where we're at, kind of the overall population and the two pools, but we're also planning to use this methodology that I'll go into now on how we want to kind of position our stop loss incentive structure. But before I get to that, I'll just show you some of the other reporting components. We asked about gaps in care, and this data is out of Springbuk. Okay, so we identified the preventative care gaps that are there, and also the essentially, if you look at the rolling 12 of 2022 versus the January report, you know, we're increasing in more gaps is really what this is saying. We have more gaps in care, and that's only an adjustment over a 1 month period of a rolling 12. So it's important. So if you go now to those chronic intervention opportunities that are described below, that's the drug, the hypertension, diabetics, the mental health, hyperlipidemia, asthmatics. Those are the members in those categories identified, and then the non-compliant. So if I were to click that non-compliant 105, for example, drug management, it would tell me all those members who are non-compliant, and we can only see them at what we call the PHI level, which can be shared with providers, or you can create communication. Just the idea that we understand what's going on, and it also does a projection of what their cost increase is going to be by being non-compliant. So the question was asked earlier, you know, how can we measure if we institute a program to change the curve, if you would? And Kelly mentioned, you know, if we tie biometrics for getting baseline information, so that's blood glucose and other risk factors in an assessment process, that can be actually put into Springbuk and then tied to the claim. So if we're doing things on a proactive way and we measure that patient, maybe that 105 goes down to 90 as an example, and then what are they becoming compliant in? We can measure that information. So just as, again, from a high level, how we are constantly looking at this data as to you know, how do we use the data in a relative way and make it meaningful for our change initiatives.
Hey, Randy, if you can go back to that, when you talk about non-compliant, nope, actually the pie chart, there you go. When you talk about like the non-compliant, is that those folks that aren't going in for their like preventative screenings and that type of thing, or what do you mean?
That's a part of it. So they classify every person. So think about what the standard ACA preventative or the A and B guidelines of the task force established for preventative guidelines that get tied also to clinical, recommendations. So if they're not compliant, that being based on the claims data that's coming to, if a person had a diagnosis, let's say of diabetes, and they're not compliant to the A1C testing, that's going to show up as a non-compliant. Okay.
Okay, that makes sense.
And then also as a preventative care, though, I could be, women's health as an example, or immunizations. All of that is relative to the non-compliance. So just based on recommendations of the standard of what individuals should be doing for preventative care. Does that help?
Yes. Yep. Thank you.
And now we get into the stop loss proposal that I've been essentially negotiating with Blue Cross. So we come to their credit, they came up with kind of a model, and it's one of those things that I was pleasantly surprised of what they're willing to consider in terms of some of the structure of it. And then they were looking for us for kind of putting the details around it. So basically, and I know this is a busy slide, and I don't know how to simplify it any more than other than this. Okay, so they came up with this proposal where we have a targeted loss ratio of 75%. What does that mean? That means if we're paying $1 million in premium, they're targeting that they're going to pay out $750,000 in claims, as that's how they're setting the rates. Every year they're saying, okay, if this is our premium, we're going to target this. Now, if you as a group perform below that 75%, so let's say we come in at 50% instead of 75, they're willing, what they're saying is we will give you up to 20%. They basically came up with 4 tiers. And I said, no, I don't want to talk about the top 3. I just want this bottom one, because that gives us the best value. So they'll say, we'll give you 20% of that back at the end of the year. Or we'll give you 100% of those savings below the 75%, up to 20%. And what does that mean for how they want to look at it? Well, they came up with this formula that says, well, based on their analysis, they need to load the premium to account for the fact that giving some of that money back. Well, we still have a lot of discussion about that point, just so you know. And so, but this was their kind of model. I proposed, I do agree that how, and most of the carriers we work with that do a premium refund agreement, they do load it to account. So they're basically saying, hey, if we start at this rate, we're going to actually load it to 11%. And now on our side, I'm saying, well, we want to get a better benefit if you're going to load it. So I came up with a model that says, if based on our population participation by groups, we get 15% of the employer groups to participate. We want to credit of up to 15% increase in the loss ratio. So instead of being 75, we get a little bit, that's going to go up slightly. So it means it increases our opportunity to win, basically, in the structure. And if we adopt the Credo network on the specialty drug with a sanction for specialty drug use on a plan design, and again, it's based on the percentage of groups that participate with that, because we know we're not going to get the entire trust to actually do it. Okay, but we'll figure out a model that says, okay, we got this many groups that are actually participating. And on a Credo, if the trust were to agree to, to use a Credo, that would automatically be back, to account to the entire trust membership. We'd get that 15% credit to raising the loss ratio. Plan design, we want to target groups that are willing to do what we call the risk pool management strategy. We want them to increase the out-of-pocket max. So that would be part of the formula. We're going to weight 40% of that increase to that loss ratio by 40% factor of those that participate with it. And then the last one are the Milliman index scores. So basically we stratify the index scores that based on where we fall out as a group, do we get a 5% increase to that credit value, 10, 20% weighted value, or 30? Ultimately, what the design is objective is to increase that loss ratio, from a 75% up to another 10%. So basically, it could push it all the way to an 85% loss ratio, and that's the objective. And I sent this model to Tony. He's reviewing it, and we're going to have a follow-up meeting here in the next week or so. I meet with Christy tomorrow where we're talking about it. But ultimately, this is what we're trying to do. What does this really mean, though? That's what everybody wants to know. Okay, come up with this model. What's the benefit to the trust? And this just gives you what I went through earlier, where we're at as a and I'm looking at, now there's two pools you got to keep in mind. So the current pool is at 0.77. So they would benefit pretty significantly in that risk index value that's established. Okay. That being the October groups. And so here's how the modeling works that we come up with to put into an agreement. So I provided them the agreement language, and then once we agree on the formula, then we get the details of the structure. Instead of illustrative, it's going to be exactly how it's administered. So how does this really work? This is an example. Okay. So I said, hey, assuming we start here, we have 1,626 employees. That's in the October pool. And our current cost is $94.79 per employee per month. We're paying 1.8 million currently in premium. And if we add the load of 11%, that gets us to 2 million. And now we start looking at those areas that we get credit in, so we can raise the loss ratio factor. And this just does a weighting analysis. Instead of going 75, it actually pushes us based on certain qualifications up to 79%. So now basically 79% divided into 2 million is $1.6 million. Okay. Then we figure out how much is eligible for the surplus. Well, it's based on our loss ratio. Now, you just need to know that D line that you can see, this is the reason we're doing all this. That is the number that they paid out. And we are paying 1.8 million. So if they paid out 418,000 and we paid out 1.8 million in premium, well, that's a hefty gain for Blue Cross Blue Shield. And as I talked to Tony about this, he said, well, you're only 18 months into it. Now we agree, that being for the October pool, but at the same time, that's a massive windfall based on the current premium structure that Blue Cross is getting. So using this model that you can see of the numbers, actual numbers that we're at today, and we got the 20% refund basis, basically of the refund that we would get, we would qualify for that $410,000 coming back to the trust of the 2.52 million that we paid. Okay, that's the basis of it. And the good news is they kind of already came up with the structure of it. They just wanted us to come up with the detail of maybe some various components. And that's what we're negotiating right now. I know this is very detailed, and I mean, it's a lot of weeds, but it's important to everybody to know how we're kind of coming through this process to get some money back based on better performance that we're willing to participate in.
So just a quick question, Randy, because this is a lot of information and it's hard to kind of wrap your head around, but
it is.
As that target loss ratio increases, it just may be a point where we're not getting any rebate back or premium refund back. Like, let's say instead of 79%, it shows 86%. At that point, we just may not get any type of refund.
Yeah, if we go above the 79, we don't get anything.
Okay.
Yeah, it's only when we perform better than the 79, which right now we're like 30%. And so we have a great chance that we're going to get that refund. Yeah. If obviously assuming that everything continues in the performance and you could have one claimant or a series of claimants, with specialty drugs now that are over $1 million that could take it all away. But at the same time, it gives us a baseline to start with, that we can work through to get some value as a benefit for a partnership structure with Blue Cross.
So then if we would be looking at, let's just use this as an example, we would be receiving a refund to the trust for $400,000, then would we be able to utilize, I'm assuming, these savings by obviously upping our reserve and then being able to determine what kind of rates we would be. I mean, obviously we wouldn't maybe want to necessarily reduce our health insurance rates, but at least hold them steady with a program like this if these funds start coming in.
So when the money, just like we're talking about on the tech credit, and that money comes back to the trust, it can go back into the trust account, and then from there you decide how much do you want to allocate to a reserve, and then how much do you want to allocate to a reduction of your funding costs because your overall costs went down. So that's, once the model and the credit is given, then those decisions can be brought forward to the board and they can decide. But this is only the October pool. Then we'd also have a whole structure for the January pool too. Same model though, in terms of how it would be operated.
No, understood. Does anybody have any questions or comments in regards to the stop loss incentive program? I know it's a lot to wrap your head around.
So, okay. And then just the other thing that we did have some discussion and they agreed to is that we will get for the January groups a credit into 2024 of $7 PEPM. So that's another $130,000 of cost reduction to the January pool. So it applies in actually 24, but it's based on whatever the current enrollment is that comes in starting January. It'd reduce that admin fee by $7 PEPM.
Randy, is there a difference in the administration cast between the renewal groups?
Yes, there is. So and it's a function of the kind of the claim utilization. So I think the other group is 59. I think that's what it is, isn't that right? Brenda? Yeah, so it's 59.
57.
Yeah, so that it is, yeah. And that was part of the points. And this was their first offer. I still have some things that I'm showing to them that I think it should be lower than, I mean, we should get more credit. But this was their first offer. Let's just put it that way. So they gave this to us 2 weeks ago in our last meeting, and I have, like I said, I have multiple follow-up meetings scheduled over the next couple of weeks to see if we can get a little bit more out of it.
I would imagine they're building in profit on all of this, right? Just like admin, the alliance fees, stop loss, all of that, right?
Yep. It's true.
Okay.
Well, they're a nonprofit entity, but but they're building it in.
They just call profit different
In a
words.
different box, right? Yeah. So now we're getting to the renewal, which everybody's waiting to see, which of course I think you've seen it now, but I think I've already kind of given an overview of the trend, what's causing trend and increases. Treatment therapies, greater emphasis to detection on diagnosis, social and economic factors, medical inflation, provider price increases, the increased burden due to aging of the population. And this is an area we at the next meeting, we'll get into a lot more discussion that we really want to focus on, which we brought up before, which is our Medicare education program, because we see high cost dollars still of the population 65 and over. The provider cost shifting from reduced payments of Medicare and Medicaid. I shared that kind of story, what's going on with the pharmacy initiative with the Inflation Reduction Act, erosion effect of the fixed dollar deductible and co-payments. So these are all areas that are driving trend. So this is kind of byproduct, and what you have an open access PPO plan. You've got the PPO, which is really what Blue Cross is at. So they're saying the trend on that for this next year is 7.9%. And I think NDPHIT probably is close. Kyle, you can comment, but I think they were close to this number for their renewal. Is that right? Is he's not still on? But I want to say that they came out with a 15% 2-year biennium. And the HMO EPO plans, and then the high deductible health plans trend. And then how much is affected by the hospital inflation component versus the physician. The continued impact of COVID, as we've mentioned, and positively, actually, telehealth is having some positive effect to reduce cost. And we talked about already about the pharmacy, but price inflation. I think we've all heard it now for the last almost 18 months, that inflation, especially in the specialty pharmacy area, is really having a big increase to the cost. And so this is an interesting slide. This is again, this is all part of the Siegel actuarial report. So open access PPO plans actual trend in 2021 was driven by a rebound in the utilization for deferred care because of COVID. But it was much higher than what they thought it was going to be. And then the RX trend, as you can see, RX trend is of where they projected to what it's actually trending at. So trending projected, actually the 8.9 is a projected number of percentage increase into 20. It's really, I'm sorry, into 2023, it's at 9.8. So it's higher than that 8.9 number. So what are the strategies that you're trying to mitigate these increases? We talked about some of them, but transparency tools, knowing more information about the cost of care, virtual counseling for behavioral health, chronic condition management. A lot of companies are adopting some things, and the population health team will bring more and more of these initiatives about this area as they talk about opportunities. Implement virtual physical therapy consultation in primary care. So Omada, which is a partner to Blue Cross, has actually come up with a pretty aggressive physical therapy consultation program that's been very effective to help mitigate cost. Cost reduction for out-of-network services. And then last year, these are this year, but last year it was adopting the HDHP. Well, we've said for years the HDHP plans do not save employers money. And it's because the high cost claimants drive the cost. It's not those that have costs below the whatever that deductible is. Expanding pharmacy management programs using healthcare transparency. Again, this was in 2021 versus 2022. Anyway, you can see kind of that comparison that's going on. So now where are we at? So we did the underwriting like we typically do. We assign 9.8% inflation trend to the pharmacy cost and 7.4% to the medical component. So it's a blend. It's a weighted number based on those two factors. So this is where it came out to be is our projected cost at $862.33. And then we look at from 2022 to 2023, and what do we get to as kind of that adjustment that's going to happen. Plus you have to add the fixed fee cost on top of this for their inflationary that we put in the final underwriting that you'll see as kind of our rate action recommendation. But ultimately we added every fee line item that we currently pay for and accounted for rebates as well as the PCORI fees and the medical rebate function that we get. So the rate action, sorry, this is kind of in the way up here, maybe.
They don't see that.
Oh, they don't see that? Oh, that's us. Okay.
That's just you.
All
Sorry.
right. So I was trying to get that bar off the top, but so this is our enrollment into 2023-24. What are we looking at? So it comes down to 4.82 as the composite increase. The fund balance reserve is recommended by the actuary was 1%, and non-wellness members would pay an additional 1%. So that's what it comes out to be, and then, whoops, moving. Did I do something?
Did you do something with remote control?
What's that? Oh, here we go. Let's do this. There we go. Okay. Then, so what does this come up on the tier options? So we came up with 3 tier options to show. Again, the composite's 4.82. Then we came up with spread between each of the tiers options from 1%, 1.25 to 1.5. Then the tiered increase based on which class you fell under as a group. So the 66 groups, basically they're divided. So you have 15 in tier 1, 19 in tier 2, 14 in tier 3, and then 18 groups in tier 4. And then if you have the fund balance structure to it, then if you're participating in wellness, there's your rate based on those tier options. If you don't participate in wellness, you add another 1%, and that's where they'll be paying if they don't participate. So really, what the decision is you want to adopt option 1, option 2, option 3, or have a greater spread even between the rates. And we try to keep them narrow, just because we thought it was the narrow might be the simplest. So if you chose option 3, then the lowest tier would be 3.88 and the highest tier would be 8.38, and so forth.
Randy, do you know how many of the groups that are in this rate tier, how many don't have the wellness program?
It's like 2 or 3 groups total that have opted not to participate in wellness.
Yeah, most of them do.
Okay, so when we're looking at premium increases, we really, for the majority of them, could look in the blue column where it, of course, blue columns,
right.
but
Really
the light blue column of total wellness. Okay.
In the unlikely chance that a group decided not to subscribe to the wellness program anymore, then they would be subject to the higher increase. But we don't really anticipate that happening. It's just, you know, for our purposes to display.
Okay, discussion, board members, what are you thinking as far as tiers? Obviously, the October rates really affect the schools the most, so I would be looking towards at least hearing from our school board members for sure, and anyone else that'd like to add what their thoughts are.
Randy, I've got just a quick question. So Randy, can you provide like the loss ratio breakdown, or how did these groups get tiered out?
Yeah, how did you decide 15, 19, 14, and 18?
Oh, you mean how many, it's in order, okay. So we looked at, there is criteria that basically they are above certain loss ratios. And the answer is yes, we came up with that methodology. It's just that I can provide that to everybody, but it's basically trying to, it's similar to what the same methodology we did on the last round.
Yeah, I think you did.
I think they adopted it exactly the same kind of a method. You know, you're above a certain loss ratio, it was this tier versus this next loss ratio and so forth.
So like the tier 4 would be like over 100% or something.
Yeah, like over 130%.
Okay.
Yeah, if you're the top tier, no, I'm sorry. Yeah, I'm sorry. If you were tier 4, you would be at the lower end. Sorry. If you were at the tier 1, you'd be at the higher tier. I mean, higher loss ratio.
Yeah, excuse me. So yeah, okay, I get it. So if you're in like tier 3 and 4, you're probably at loss ratios under 70 or 60 or something.
Yeah, probably between, I would say, the more like the 80 to 95%, because you're drawing the value down, and then once you get into tier 1 and 2, of course, you're getting above 100 both of those sections. But I apologize, we didn't include it, but it was the same methodology we used on kind of the last structure.
So just a question about the wellness, I'm going to guess we don't have great engagement in that 1%, and I'm just wondering, is it, just because we sign off that we're in that wellness?
Yeah.
Well,
I would say to keep in mind that is continuing to expand. Obviously, we talked quite a bit about some of the wellness initiatives that we're going to be rolling out, particularly with the pilot program for Dunn County.
What were you thinking?
I'm not sure what my question here is, guys.
Okay. Other than, well, you bring up a really good point. Okay, because I didn't go into this dialogue, but because the way we're trying to structure that premium refund for the stop loss is getting groups to actually participate in the screening events. Well, if you're not putting some teeth into why they should participate, then you're not going to get it. We can't leverage the value of how much we can get, not just as a program initiative, but it also can minimize our opportunity to increase our refund our refund structure within the stop loss.
And maybe you're clarifying my question here. I think it's a carrot, but does the carrot actually make us healthier at this point in time? I don't know in our district, knowing how our wellness is going. Yes, we're signed up, but I think we get $250 towards something. I don't know. I mean, that hasn't exactly encouraged anything other than, make sure we're on that so we get the fee reduction.
Well, it's a great point, because we originally did this because we brought all these groups over from NDPHIT, and that's when we did that. That's the first thing they asked. Are you going to give us that 1%? Well, so we had to structure something that emulated. But the fact is, I think your point is, are we really getting value to basically give a windfall of $500,000?
Yeah.
To the groups, because if you look at the entire trust at $50 million, we're literally giving a credit of $500,000 for that 1%.
Well, and something that we identified that was lacking in the wellness engagement was the ability for Thriver to actually reach out and connect with groups, and that's why we we've been modifying the wellness agreement to account for that kind of that shortfall so that we can get better engagement.
Well, so we thought of one thing just to say, you have to agree at least to support the on-site screening event if you want that 1%. Not that you're just doing wellness, but you actually have to say, we're willing to do this.
And it would really be to engage and communicate with employees to encourage them to attend those screenings, because that's where you start to get the engagement that we've been lacking.
Yeah, it's that one-on-one environment that increasing that opportunity, putting more branding name, as you know, Jenny alluded to earlier, and that is, this is really an NDPHIT initiative, and we really, we're here to support you, but you've got to actually at that employer level need to be willing to do some things too.
Yep.
Can you go back to in July when we set the January rates, right? Wasn't that in July for the January group? We had discussed whether we should just, I think I was one that said, well, maybe we should just pick in the middle, but you had a recommendation for us, didn't you, about we should be maybe at a higher level than what we had in that other group?
Meaning the tier?
In the tier, yeah, which tier we went with, or which option we went with.
Well, if you want to be, it's a great question, Steve. I think if you want to be closer to that approach, then in the structure, then you're really focused more closer to that. I love the option 3, which is, the higher tier is going to pay a little bit higher. In other words, the spread is higher. And the better performing groups get the 3.88, and those that are at a higher loss ratio, the highest loss ratio, are going to be 8.38. That's why that's kind of shaded in gray as we have it, is because we think that's probably maybe the closer methodology. In fact, Stutzman County specifically was asking that question. What are you going to do with the tier structure for the October groups? So, well, we haven't got to that yet, but we're going to try to keep consistent with the same methodology.
My question also is, well, in my mind, probably like Steve's, what group am I?
Oh, I knew that's what everybody was thinking. Was that Mike that asked that question?
Yeah.
That's a good point, but that's the whole point of being a fiduciary, Mike.
I think Mike, you're in the tier 4, if I remember right, because I actually looked at yours. I can't remember else I looked at, but I think you're either 3 or 4. I'm pretty sure it's 4.
Is that
oh, go ahead, Steve.
I'm sorry. Is that a document that's shared, or how does that get communicated then? I mean, shortly after this, because that is going to be everybody's question. Is that individual, or does everybody get provided a list? Is it's just common information? I can see what other districts' tiers are as well as mine.
We do actually share we've gone to each individual group to share their loss ratio.
Okay.
So once the trustees decide on the tiering structure, then it would be communicated out on an individual basis. We don't really share kind of, the full spreadsheet with all the groups. We usually make that, independent. So it's based on just the group that's receiving it.
And I think, Steve, just so you know, I looked at yours and you are right on the line of tier 2 and 3, but you're above the line. So you're tier 2.
Okay.
I found those loss ratio breakdowns as we were talking. So basically anything above 119 is where we fell for the political subdivision group. So that was the tier 1 in this case. And then between 96% and 100 and, well, the highest group I see here is 113, but it would be the spread up to the 119. That's the tier 2. And then below,
and those are the groups, just to clarify, those are the groups that are costing NDPHIT money.
Yeah.
Yes.
Right. I mean, that's when you're
correct.
They're costing the plan the money.
Yep. So then it's basically 95% to 75% is in the tier 3, and then 70% and below, or 74% and below is the tier 4.
And if I remember right, to Adam, the underwriter, it might be just a little bit difference in the point structure that John read, but it's fairly close. They tried to keep it again as close as they could in order to make the model work based on how many groups were in those tiers and the composite loss ratio overall.
I know from my perspective, and I said this back in July too, when we were setting rates for January, I always would point to the more spread, the better from an adverse selection standpoint. And where we go with that is you've got the good risks you want to make sure you keep in the plan. And the bad risks, they're the ones costing the program the money. And we look at it on the PNC side where you end up, if you're subsidizing the bad groups with the good groups, you end up in a situation where over time, the good groups will look at other options and likely leave. And then you're hurting your program. And so we take those same actions at the reserve fund where we ensure that basically we just call it paying your fair share. If you're the one that's costing the group the money, you've got to be the ones that end up paying a little bit more than the other groups. And I would encourage, the folks from SEEK and Brown & Brown to make sure that the education around whatever the board decides, is provided, especially to those groups with the higher increases, to ensure that they understand, okay, well, our loss ratio is 119%. Of course, we can't expect a low increase compared to those groups that say have a 35% loss ratio. Well, that's a whole different world there. So that's from my perspective, just looking at it from a PNC standpoint, the bigger the spread, the better from an adverse selection perspective.
You make an excellent point, Brennan. And remember when we were talking about this in July, it kind of, because again, we're utilizing this process as kind of a motivation to adopt some strategies that do, allow for a better loss ratio going forward. And that would be, again, some of those risk pool management strategies that we talked about. Could be Medicare education or some of the other things that we are trying to encourage groups to do to be more cognizant of their risk and where they sit in that tier structure.
And just to let you know, that very discussion or that point that you made there, Brennan, was the hour-and-a-half meeting that I had with the commissioners at Stutzman County about adverse selection. And they didn't understand it. They didn't understand. I said, this isn't like money we can go, we're not a big insurance company. Everybody has to stand on their own, but it's the idea that we pool the risk. And if you're at higher, you have to pay the freight. And so once they got it, once they understood how it's structured, they realized they actually were in a great position. And to continue participation with trust.
So how does this, okay, let's say I'm tier 1, right? I know that you guys communicated this to the January groups. It didn't go super hot, I'm sure, in certain situations. So you mentioned strategies. If I'm, okay, Randy, you call me or am I forgetting your name?
John, yeah.
John, sorry. You call me because I think you're the bearer of bad news sometimes with that, I think.
We are.
Yeah. So anyway, I'm gonna say, okay, John, what do I gotta do? I'm starting negotiations here. I don't know when this is gonna go out, but we're gonna be starting negotiations when the session ends here. What do I gotta do to get to the tier 4, right? Help me. What can I do? Can you come in and, as I'm communicating this, my teachers union, look, if we were at this percent, we could put that percentage on the base and that'd be awesome. But tell me how to get there. What do I got to do? Well, that means we got to completely revamp our insurance plan. We got a higher deductible, whatever, or we got more out of pocket cost. Those are the things that I hope that we're going to be providing.
Yep. Well, yeah, and this goes again back to a lot of the discussion that we had in July, but we basically identified, what is the low-hanging fruit that we can really work with these groups on that they can look at. And if you remember the discussion, we we kind of came to the point of the out-of-pocket max is the best opportunity for them to make an immediate impact and as well as a long-term impact. So basically what we displayed to each of the groups was, okay, so if you increase your out-of-pocket maximum by $1,000, what this, and we gave them basically a model that showed here's $1,000 out-of-pocket max increase as well as your immediate discount to that renewal amount, and it was generally anywhere from 1% to 2% per $1,000 of out-of-pocket max increase.
And probably most relevant to that discussion is that it almost generally only affected 1% to 3% of the population. That was hard for them to get their heads wrapped around. That it's like it's not very many people that are actually affected by this, but your cost can be reduced significantly.
And I would want you guys, and I'm sure you do this, and I would want, like, sometimes when we communicate that as a, you know, coming from our standpoint, they may not always agree with, you know, or believe, I don't know. But it'd be helpful to kind of talk about that with the teachers union. And so anyway, I could see maybe just making sure they're aware of that you guys will assist with some of that education.
We do, and we've met with school boards, we've met with you know, the admin teams, or all of them collectively. We've literally tried to make sure that everybody is educated and aware of kind of both the strategy and the options, and then, you know, what the process is to do it.
The other thing that's important to that is if, you know, you have a particular group that has a concern about increasing the out-of-pocket maximum. We haven't talked a lot about it, but there is a gap plan that we rolled out in partnership with Transamerica that allows basically for a coverage for, so if you have an individual on the plan that's concerned about that liability, because they, you know, they may know that they're a high cost claimant at the beginning of the year, well, they can actually opt for that health gap plan so it comes with basically a small premium amount that would cover the entire out-of-pocket maximum amount for them in any given year. So that's an important consideration as well for groups that do want to adopt a little bit higher out-of-pocket maximum, you know, to reduce their loss ratio.
But we include that as part of the entire education. So
yep.
We're very sensitive to what you're describing, Mike, as to make sure we're very proactive, sensitive to all the stakeholders that are affected by any change as well.
Yeah, I guess my comment too is going to be as far as the options, you know, that option 3 is probably the best approach. I think going back to the fall, the only time it would be under consideration if tier 1 gets too high, where you have to feel like, well, you know, when we spread it out, that just gets a little too high that people aren't comfortable. So you got to pick a tier where it's a little bit closer together. But, you know, as far as 8 being the top tier, I don't think that's out of anybody's realm of what they expected maybe this year with possible costs. But I want to go back to that piece, the educational piece. That is there a pretty clear breakdown as far as each school, as far as the tier and your stop loss, so that you can educate your employees as to why, you know, if we were close from tier 3 but missed it by a little bit, was that some choices made by our employees that could have been adjusted, you know, to try to educate into there's an impact in everything you do. I mean, when there's utilization, there's an impact, and, you know, start to not change behavior, but to better understand the impacts of choices. I mean, is that part of that component? So you can actually, you know,
yep. Absolutely. A good example of that, Steve, could be, you know, maybe you have some individuals that are choosing to go to the emergency room when they're actually dealing with a condition that could have been handled in an urgent care setting.
Right.
You know, because we know that we can look at the data and identify what are some of these conditions that were handled in the emergency room that could have been taken care of in an urgent care type visit.
And the way that the trust data is set up in Plan IT, we literally have it at the global level of the trust, then at each individual group, and look at their specific, not only their utilization, but the conditions that are driving their cost.
Okay.
And the benefits structure that's driving their cost.
And we'd be able to get that information, and so we could use it in talking to our employees and educate them as far as our breakdowns and utilizations. That's all easy to get and request.
Yep.
Okay.
I'd love just wherever we fall, I would love to just have some education for my, negotiators, just in general on this topic of stop loss and what that means. I mean, I don't know if that's something where you guys could just put together a 5-minute spiel that's, that we could all access and give people. Like I would, hey, look, all right, our first, as before we begin our negotiation cycle, these meetings, we're going to get educated on, health insurance somehow, in 5 minutes.
Yeah.
Just about this topic, so that, again, whether it's the wellness thing, like, hey guys, the fact that your wellness matters to this plan more so than ever. When we were on Blue Cross back in the day before this, it's just kind of like do whatever you wanted. Now we can see some significant savings if you do these things, if you participate in this on-site screening, if you maybe make some better decisions on how you approach your health insurance. And so I would like to have some kind of a pre-recorded thing that I could share with my people. That would be helpful. I don't know if that's something, John, you can put together.
So we are working on a video that is really meant more kind of for the stakeholders. So that could be your school board or anyone else that may sit on a health insurance committee that talks specifically about adjustments to the out-of-pocket max and other strategy ideas. But are you thinking of something that would be delivered to your general membership?
Yeah, just like a tutorial.
I don't think they would watch it. I think,
that's what I was going to get at.
Negotiating, that's who I want to say, look, we're going to watch this because we need to have a better understanding about, like, this conversation we're having. They don't have we're controlling our costs here and who's going to pay what. And so we have some choice on how we approach things. And I don't think they know that.
Yeah, you bring up a really good point, and we've kind of anticipated that that's the direction we need to go, because again, we're a little bit limited with our point of contact at each group, and recognizing that we're not able to get in front of every decision-making body, for each of the districts. So yeah, we are working on that. We should have something available here in the coming weeks that we'll send out, and of course welcome any feedback. If you wanted to let us know if there's additional information that you'd like to see, we're happy to share that detail with you.
But even on the flip side of things too, for the groups that are at the 3.88%, what are you doing right? Being able to, oh God, we're at 9%. What can we do to get better? But I think also letting the lower end folks, saying, hey, because you made these choices or did these things, or you have over half of your group in the wellness program and it's making a difference. And because sometimes if you get that positive reinforcement of what you're doing right, it will kind of, it's the word I'm looking for. It's like a waterfall, it's like, oh, we're doing this right. Well, we should get others involved. So there's kind of two spectrums to that as well to consider.
Yeah, it's a good point too. I guess not just looking at my tier, but just looking at, what would it take to be in tier 1 and what quantifies that tier? What differentiated that? So what does it look like, in a tier 1 compared to maybe the tier that I'm in, and to be able to kind of see the context of that? Because that would be helpful to give them a frame of reference. Like, you got to, we didn't know there was a consequence to some of these actions. I mean, for us, it might have been labor and delivery because we have a very young staff, paternity leave are very high. That may not be the case, but that's an assumption, but be able to look at that and say, what's the impact of that compared to others? We know we're not unhealthier than rugby. So that's going to burn us a little bit. There's no way.
Well, to pile on to that discussion about the education piece, I mean, this is one of the main reasons why NDPHIT was created. Everybody was getting these increases and nobody knew what was going on, why it was happening, how do you affect it? And if we remember back to delivering the January renewals, the one comment that will probably stick with me forever is the comment we got from a group that had the highest increase, and they said, well, this is just more of the same. This is just more of what we had before. And now what Mike and Steve and Jenny are talking about are the opportunities then that we learned in the last time, in the last increases, that we can put into place now to have that differentiator. If you get the 8.3% increase, it's a lot more palatable if you understand why. Well, and that's what we saw with Stutzman County. It's like, okay, well, you're kind of left hanging, but well, why does that happen? And how do we improve it? And so this is that opportunity. I just kind of ask Brown and Brown and seek to take that, take the bull by the horns here a little bit and say, okay, let's be that difference versus just, again, not having that comment of this is just more of the same. And let's avoid those situations moving forward.
Absolutely. And to that point, we did spend quite a bit of time working with Stutzman County, both our point of contact at the auditor and HR level, as well as having a separate meeting with the commissioners. And there just was really little appetite for making any plan design adjustments. And, you know, given that that was kind of the prime area that we were focusing on as low hanging fruit, you know, they opted not to make any adjustments, even though it could have saved them up to 8% off their renewal increase amount. So,
but I think Brent's point is that,
but
literally,
yeah,
we should come up with a tutorial, like Mike is suggesting, that gives all the parameters that went into the renewal, that gives them the why. You know, why is this happening? And more importantly, what can I do?
So-
well, and if you remember back, what we did, we had a series of webinars where we talked through what was driving the renewal and why it was what it was. And we did do kind of the overview of some of the strategies that we're going to be outlining to each individual group. So I don't know, do you guys remember participating in those webinars that Randy and Brendan hosted just after the renewal?
Yes.
Yeah, and I think that was a good thing, but it was clear based on the results that we had in the renewal deliveries for January, not everybody either saw those or understood what was happening based on the webinar. So I think it's just finding the avenues to communicate it that people will respond to. And I think when you hear it from, Mike, who's handling this at the ground level, saying, here's what I need, I think that's where we've got to target, saying, yeah, let's do that. This is what our groups want. This is the reason why we've got a board to say, okay, this is the direction we want to go to be able to provide this type of information. And I think in all of the above, and we see it with the NDRF, where we're when you communicate out information, it's kind of an all of the above solution where, okay, webinars is great. Maybe a written communication, maybe a video that people can log into at different times. In person is always the best I've found, but we also understand that can be a challenge too. So kind of taking that spread across all different avenues. And I think Mike's idea was awesome. That a video that he can show to the folks that are directly involved in the negotiation is great.
Yeah, and if you get too high level, I think if we get to our numbers, I mean, you talk about the pool and everything else that everybody just glazes over, but also these are our numbers, and this is what's caused us to be in this tier. It becomes very personal. $250 doesn't always impact people's decision, but when they look and say 3% equals this dollars, and man, choices we're making is this much difference in our premiums. I don't know if it's been that real before. Like I said, it's been this thing that out of our control. Blue Cross, it's just crazy. But now all of a sudden, these actions are relating to differences that we're paying versus somebody else in the pool. If we get to that level, I think we're going to get some good conversations versus the bigger level. They'll just tune out. So if we can get to that level.
Right. Well, and if you remember back, something else that we talked about last year was just the concept, especially at the political subdivisions, how a lot of people well beyond retirement age are just sticking with the employer plans. And Jenny will attest to this, but we sent over, some of the individualized data, even for her group of people that fall into that category that could look at Medicare as an alternative, but they just, they've never been educated on it. They don't know what's available with Medicare versus what they're getting with their group plan. And it seems difficult to make an adjustment there when that population of individuals could be driving this cost.
Well, and it's that comfort level. They know what they know with their current plan, and going to Medicare sounds scary. But I'm still a full-time employee, and why do I need to do this? That's kind of where it came down from us. And and you can't force them to do that. And so it's an education piece. It's having patience and grace and trying to help them. But I also think too, even from Stutzman County's perspective, even though they decided not to change anything in their plan, I think when you all walked away, they at least had a better foundational understanding of the why. And I
Right.
think that's what's really important is just helping our members understand the why. And then they can take that information to determine if they want to be making adjustments to help them reduce their premiums or whatever the case is. But I'm echoing what Brennan said and what Mike said. It's that point of when you're in the big pool and you don't really think your choices make a difference, understanding what it really means to be in a trust and how your choices are very important in how you moving forward, if you will, or how we move forward as a group. That education piece, I think, is going to be crucial in helping our members have a base understanding or that foundation of what they need to do moving forward to make our trust a success.
Yep.
So are we landing on option 3 then?
I would entertain a motion if someone would like to do that.
So moved.
Thank you, Brennan. Is there a second?
I will second that.
All right, thanks, Steve. Is there any further discussion?
The only thing that I would add is that, like, we talked about this education piece, and I don't know if we've kind of honed in on that, so like there's 66 groups here. I'm going to go, all 66 want to meet with John, and they all want something different, or maybe they don't want anything, or they're just mad. Like, I don't know if it makes sense just to kind of have some, kind of like what Steve was talking about, some general, like, how do I get from 2 to 4? Like, can you come up with these general sort of, what are the decisions? I can tell you Steve, for us, we just hire people that are really young and they're not married yet. Have babies. And so that's maybe in 5 years we'll be there, but you know what I mean? Like, that's not a great strategy.
Right.
Yeah. So you're saying give the 3 or 4 most important points that a group could do.
Yeah.
To improve their positioning and their loss ratio and their experience, and ultimately improve the population health at the same time.
Yep. Take this slide you have here and use it as some component of it. Talk about it. Like, what does this mean? And then how do I just 4 or 5 things that I could, move to the next tier.
Yep.
In a 5-minute video,
I agree. I think that would be very helpful and good sharing to the groups, our groups, as we look at what that cost is going to be. I like that.
And I would assume the ones in tier 4 are all in a high deductible health plan. Just assuming that.
No. In fact, there's probably very few high deductible health plans in the entire pool for the schools. There's a few, but not very many. I'd say maybe 6 or 7 that of the 66 that offer it as an option. So it's really, there are many factors, but I think what you're asking is, well, tell us what those factors are that we can understand, and then how do we adopt it into the plan structure or the offering that we do as an organization. There are some clear things that we will highly advise that we know, like I won't get into right now, but we know that some of the schools are doing things that is creating adverse selection. We know that for a fact, and we want to point it out to them and call it out. We didn't do it on the first round, but we're prepared to do it on this round because it's affecting the loss ratio of their group and the pool. And one other point I was going to make that I just want to get clarity on that would give us some direction, and that is, are we comfortable saying that with the wellness program that they have to at least opt into agreeing that they will support on-site screenings? We're not saying that this year if it doesn't meet the timing, but basically we're saying we want the groups to agree that if we can schedule it with you, you would do an on-site screen, and therefore that triggers your ability to qualify for that 1%.
I think that's a proactive option for our groups.
It is. It makes them more accountable, and it certainly spurs the conversation much more proactive.
Mm-hmm. Okay, we do have a motion on the floor. Is there any further discussion in regards to rates? The motion is to adopt option 3. Okay, hearing no further discussion, all of those opposed to selecting option 3, say aye. Okay, motion carried. Anybody else have any input on what Randy was talking about, doing a requirement of at least being open to being part of the on-site screening process? Do any of you see that as an issue in regards to opting in for the discount?
I really don't. If we know in our district that we're offering this and we encourage staff to come into that, we're saying they have that option to come in for the screening. We just want to bring it to the schools or to our
That's
group.
right. Exactly. You're willing to opt into it and then schedule it in the course of the year, what works within your schedule structure. We're not saying how many actually have to participate. We're just saying you're willing to support it as an organization, and coordinate the requirements of, what's communicated, made available, and a, defined date, that just like we're doing with Dunn County. And again, this would be into next year, that it's going to be, made available, from October to September time frame. So there's time to plan for it, get everything on the docket, how it works, so they feel comfortable with the whole process.
Personally, I think I support that. And like you said, support on-site screening.
Did someone else have a comment?
Are you guys clear on kind of what I'm asking for, this education piece?
Oh, yeah. Very
Okay. All right.
That's going to be, that's very clear.
Do we need a motion to put that into the agreement?
We would, because we'll have to update the participation agreement for the wellness, to put that, that language in there that they're willing to support the on-site screens.
And that support would essentially guarantee that 1%, correct? Not
Yeah, they would, it supports that 1%. That's one of those other factors they would have to agree to get the 1%.
I'm thinking, since that's updating the plan documents, if you will, I don't know if the plan document is that the right word, Randy, but the agreements.
It's a participation, it's a
wellness participation.
It's a wellness participation agreement.
Yeah, I'm wondering if we should have a formal motion, since that's a change to the agreements with the entities. So I would entertain a motion to include that 1%.
And this would be for the October group, correct?
October, and it would also, we'll apply it to January too. I mean,
We can make it both.
Mm-hmm.
I would make that a motion.
Okay, thank you, Steve. Is there a second?
Second.
Okay, thanks, Cole. Any further discussion? Okay, all those not in favor of the motion signify by saying aye. All right, motion carried. All right, any further discussion on any of these topics, rates, education piece, before we move into the financials?
I do.
Okay.
Who's communicating everyone's rates and when, because everyone's already asking me.
Well, we will, we're as soon as, that's our team will work with you on all the communication for just like we did last time. We'll put together a formal email with the introduction, and then, but we'll work that with you.
And then we'll let them know.
We'll let them, because they're all waiting. We're getting,
yes,
you're getting calls, we're
I'm getting calls. Yes. Okay. All right. Never mind. We're good.
Okay.
Can I make one comment or one update? We did reach out to Voya and iSolved, and both are open to participation or performance guarantees. And I would recommend that if you are going to require all of your member groups to participate with COBRA, that you do also update your participation agreements with them, indicating what that responsibility would entail.
So once we get those performance guarantees, I outlined and agreed to, or sent over for everybody to look at, and that you're endorsing, with those performance guarantees, then we'll finalize that piece of it.
But that does bring up a good discussion. And since we do have the board here, do we want to require NDPHIT members to utilize the Cobra administrator that we are providing for our plan? Or do we still want to leave it open that you can utilize whoever you'd like?
Do you test it out first? And see, and then if it's good, we require, or I suppose we would find another vendor too if they don't deliver.
What's the benefit of requiring it? I guess would be, I mean, do we?
It's just that it's actually NDPHIT's responsibility that Cobra is done for the members.
So if a member does not fulfill their Cobra responsibility, it's actually not on the member, it's on NDPHIT.
That is correct.
Yeah, that's correct.
So that's the benefit there then of ensuring that groups
Are
comply with Cobra through our vendor.
And it mitigates our risk.
Right.
Mhm.
Okay.
And I would assume there would be some efficiencies into that as well. I mean, I'm even just thinking from the standpoint, if you have all of your groups working with one entity, just the efficiency standpoint of utilizing that, questions coming in, understanding, what you need to use or what's missing. It's kind of nice to have uniformity across the board as well, but.
Yes.
I know there is a risk when you do move to another, administrator, like Mike said, is there a test drive? Can we test drive it for a year and see how it goes? And maybe that's something we want to consider, but,
Well, your 10-1 groups would be your test drive.
mhm.
And otherwise, if we're looking at modifying participation agreements, we could put language in the participation agreements that says, basically, if you utilize our vendor, this is the expectation. If you don't utilize our vendor, this is the expectation. So you could outline it either way within the participation agreements. So
And currently how it's outlined, Stephanie, is if you use NDPHIT's provider, these are the expectations. And if you use your own, then this is where that falls for your response.
I don't believe there is anything in the participation agreements about Cobra specifically because there isn't an NDPHIT contract.
Oh, okay. That makes sense.
Mm-hmm. But because you're going to be directly contracted, this is now an NDPHIT offered product and you are the plan sponsor.
Mhm.
That I would recommend that for additional protections that you update those participation agreements with more specific language surrounding Cobra and what the member group's responsibilities are under that NDPHIT umbrella.
Do you know how many other entities our member groups are using outside of WEX?
I don't. I don't.
Okay, because I'm thinking if it's only affecting 2 or 3 groups, then, it might be worth just saying, here's our new Cobra administrator. But if
no, it's more than 2 or 3. I know that. But I don't have the exact count. I know I reviewed it with Brenda just recently.
I believe there was 89 groups on WEX. So
89 of the 112.
of the 112. Something near that. I can't remember off the top of my head.
Can we, before we mandate it, can we dig into, and maybe working with our general counsel or somebody else that would understand what's happening here, some sort of language that if we have this option through, whatever vendor for Cobra, if you don't utilize this vendor, you've got to accept the risk. Is there a way to, and I don't know that answer. So can we work with somebody to figure out what that answer is? Because I think that's the biggest concern I would have is I would hate to jeopardize NDPHIT through some sort of issue because a group doesn't comply with Cobra appropriately when we've got a vendor there that they've already paid for to utilize.
Right, completely agree, Brennan.
Yeah.
Mhm.
And if we can't pass that risk on to those groups, then I think we've got to mandate it just to protect NDPHIT.
So would that be a Zach question, Brennan, or
Yeah.
would that be Brown and, okay,
Well, Zach, or if there's another attorney, maybe at Brown and Brown or somebody that can help us answer that question.
We can talk to our internal compliance team and then connect them with Zach so they can have the conversation. That might be better once we get to the requirements. and for the contractual obligation. And then they can collectively decide and Zach ultimately make a recommendation of the language that should be put in there after he talks to our compliance attorneys.
Great. Okay. Awesome. That'd be awesome.
Yeah, that'd be great.
Yeah.
And then I think we can make a determination then based on whatever that opinion is that comes back in regards to the liability issues on whether they would use our plan or not. Okay, well, let's move on to financials. Nora?
Okay, I know you guys have seen a lot of numbers, so I'm gonna try and make this quick. Can you see the financial?
Yes.
Yep.
Okay.
Yes.
So I'm gonna talk about December's really quick. I know I sent this a while ago and it wasn't in the packet, but just so you guys are aware, like what the circumstances was. I know Brendan asked me a question this morning. One of the things to look at, we still have 6.9 million in assets at the end of the year and it's cash. Some of those are the deposit, but it's still an asset. It's still our cash. The other thing is our IBNR reserve is up over 2.3 million. That is not adjusted by our actuary yet. Brenna could chime in. I don't know when, I know that's coming up, but that actually hasn't been completed yet. And so that number will change potentially come or once the actuary has a chance to evaluate and see where they come at with our reserve number. It could go up or it could go down. It's gone either way with our reserve as well. I think we are on the conservative side. I believe last year it was about 1.7 million at the end of the year. We did add groups since then, but that could potentially change. So down below, you see our members' equity in total is still at 3.2 million after that IBNR reserve. 3.8 of that is the member deposits, but it's still our equity. We still knew like going in, we wanted to have, you know, something there to build this on. Of the 567,000 in loss, most of that is attributed to the 2021 one that was carried forward. About 420,000 of that was from last year. And we did have a little bit of an increase to the loss in the current year. Through November, it looked really good. However, one of the things I mentioned to Brennan is in December, since we have a lot of January groups, and you see this loss ratio happen in September as well, right before the end of the plan year. A lot of people want to they've met their deductibles, so they want to go in and before the new year and they have to start all over with their deductibles. They go in and get different things done and stuff. So you'll see in December, our loss ratio was at 144%. So clearly that's going to affect our overall loss ratio for the year. There was just a lot of activity that was going on in December. Could have been, you know, other things as well, things going on. Our weather has been awful. So, you know, people get sick, things of that nature. But a lot of that is going to be, our September months are usually going to look high in December because it's the end of our plan years. And that's when people are going to go make sure that they get things done to take care of the deductible. That overall gave us a 96% loss ratio before IBNR. We increased IBNR from December 2021 to December 2022, about 575,000. Again, that is subject to change. We don't know what the actuary is going to come back with. We were more conservative this year, what we were getting from Mike Lee at Brown and Brown. So it was a more conservative estimate that was happening this year. So it's potentially that could swing the other way. We'll just have to see what the actuary comes up with. We will obviously have an updated financial once that work is done. Our operating expense stays really consistent at that 3%, but with a 98% loss ratio with IBNR, obviously that's, you know, over 100% loss ratio. So we got 101% loss, our overall percentage. So we did have a little bit of a negative this year. Net underwriting income was 192. We had 44,000 in interest, which was a lot better than last year with the switch in banks. Hopefully next year we continue to increase that with the utilization of those CDs at those higher rates. But overall, our net loss for the year was 148,000. But you can see a huge chunk of that swing was December, $1.8 million loss in December alone. So that was the real swing in our year for 2022. Again, with it only being 148,000, there might be an adjustment to IBNR when we get that report back, but that's what was happening. So it was a better last year. Again, in 2021, we had a loss of 420,000. This year it was down to 150. Hopefully we're starting to get some things under control. And again, that loss IBNR could change as well. we'll go to February, so you can kind of see what was going on. Maybe not so big, so you can see it. So February, we're up. You see the new CDs that are in there. Well, I don't think I have that right. I have to put that at 1 million, sorry. But overall, between CDs and cash, it was at 8.2 million at the end of February. So doing really well asset wise, cash flow wise, plenty of assets to pay our claims that are coming in. The IBNR increase went up a little bit. This is January's number from Mike at Brown & Brown. We don't have February's yet. It's not far enough into March, but so that's the same as January's, but it did creep up a little bit, but not by much. Again, that potentially could be adjusted come time when we have our outside actuary complete their report. But our operating surplus, as you can see, jumped significantly from end of year, what we're currently at, to February through February. Member deposits stayed the same, but our operating surplus went up to 584,000 from that negative. And we'll go look at what we show for here. So for the IBNR change wasn't a huge change, but you can see there was a lot less activity. Our January activity was even less. I think our loss ratio in January was only 78%. So that's another one of those things. People were going in December, not going in January, getting it into last year's plan year. But even in a 92% loss ratio in February, still only took us to about 85% loss ratio with that IBNR increase to $2.4 million. So that's what's leading us to net underwriting income through February for 2023 of over 1.1 million. Interest, you can see it's already up at 29,000. We had 44,000 for the entire year of 2022. So that's looking good. So overall, our net earnings for 2023 are about 1.15 million. I know that was a lot and fast, but you guys have sat through a lot of numbers today. So you're trying to make it short and sweet, but I will answer any questions you have. Brenna does all the work. I compile these financials and add the IBNR. So if you have any specific questions, she'd be able to answer them as well.
You were right on the CD. The last 250 wasn't until March. So
okay.
No worries.
Okay. Just make sure. Thanks. I'm like, gosh, Million, am I missing something?
No,
I make mistakes too. I don't like to admit it very often, but occasionally.
All right, thanks, Nora. Does anybody have any questions on the financials? Okay, if I could entertain a motion to approve the financial statements.
So moved.
All right, is there a second?
I'll second it.
Thanks. All right, we have a motion, a second. All those are not in favor of approving the financials signify by saying aye. All right, motion carried. Whew, it's been a long board meeting. So the last thing on the agenda is our next NDPHIT board meeting, and I'm hoping with this being in more of these summer months, we actually could maybe meet in person. So do we have any suggestions? Let's think. We are in what, March, April, May would be in June. Is that right? Brenna, if you can help me with that, is that correct? June?
Yeah. Well, we're gonna have to do January.
July.
Remember that.
So it would probably be, when did, I'm trying to remember, probably July.
It was July.
Because we have to get enough data to approve the January rates. And we don't, I think last year it was like the second or third week of July. And then we release them as soon as we can, so that all the municipalities can do their budgeting. Because we try to coincide with that, but we have to have enough data to make sure that it's credible. So I think it's July is the next one.
Well, Brenna, your doodle polls work really well. If you want to just maybe throw some suggested dates out to board members, and then we can get a date set for July. All right, anything else to come before the board? Great meeting, everyone. Good discussion. And then for those that are on the task force meeting, I don't foresee this being a real long meeting, but if we could adjourn and then let's take 5, and then if we can just come back, and I'm thinking no more than 10 minutes, we should be able to kind of wrap up what we're looking at. So if there's no other business, I will adjourn the meeting. Thank you all. And then
Jenny, you want to stay on this call for that task force?
Yeah, if we can.
Okay.
But if we can just take 5 minutes to do a quick bathroom break or whatever, and then come back, and then we'll just do a quick debrief on that.
Perfect. Sounds
All
good.
right. Thanks.
Thanks, everyone.
And Nora, if you're still on, if you would mind unsharing your screen, that would be awesome.
Date, right? On it.